morning. It is Tuesday, January 10th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Stasi. And here's what you need to know as the clock hits 9 a.m. Futures are in the red this morning with all eyes on Fed Chair Jerome Powell. He's speaking while concerns over higher interest rates linger for investors. We'll bring you the details on his comments.
Plus another brutal quarter from Bed Bath & Beyond just days after the company warned of potential bankruptcy. I've got 7 shocking stats you need to know from that really bad earnings report.
And Coinbase cutting about a fifth of its workforce as it looks to navigate the crypto downturn. We'll talk to one analyst on what could come next for the company later on in the show. But we begin today with our top story.
Investors are closely watching an overseas speech from Fed Chair Jerome Powell this morning as he addresses central bank independence. Yahoo Finance Fed correspondent Jen Schomburger is all over this one. Jen.
Hey there. Good morning, Brian. That's right. Fed Chair Powell making the case for the Federal Reserve's independence in a speech in Stockholm, Sweden, though the speech not mentioning monetary policy. The Fed chair appears to defend the Fed's aggressive rate hike campaign, framing the Fed's independence as necessary as stable inflation is the foundation of a healthy economy. And that could require taking actions that perhaps not popular, but necessary. The Fed chair saying, quote, "The case for monetary policy independence lies in the benefits of insulating monetary policy decisions from short-term political considerations. Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy." Of course, Powell's comments coming as the Fed has raised rates by 4.25 percentage points over the past year in the most aggressive manner since the 1980s. The Fed chair has repeatedly warned that bringing down inflation would be painful, arguing that the central bank is going to remain steadfast in raising rates and holding them at elevated levels to combat inflation, even as markets pricing in rate cuts later this year. Now, Powell said the Fed should resist the temptation to broaden the central bank's scope to include social issues. He underscored that the central bank should, quote, "stick to our knitting and not wander off to pursue perceived social benefits that are not tightly linked to our statutory goals and authorities." Though when it comes to climate change, Powell noted that in his view, the Fed does have narrow responsibilities to supervise climate-related financial risks for banks. He said, quote, "Without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy. We are not and will not be a climate policymaker." Now, Powell is expected to answer some questions after making this speech, where we will closely monitor whether he will make any mention of monetary policy or his outlook for inflation ahead of the Fed's next policy meeting on February 1st. I will be monitoring that and will bring you those headlines as needed. Back to you.
All right, Yahoo Finance's own Jen Schomburger. Jen, thanks so much for teeing up the discussion here. You know, just as we continue to evaluate where the equities markets are going to continue to move, at least here in the pre-market, on any of the commentary that continues to come out of Fed Chair Jerome Powell, even though the speech itself is already out there and available and people are listening as well. I think at the end of the day, it's the FOMC that has continued to be kind of the cold water crew on the equity markets, unfortunately, while they're trying to get to that dual mandate. And nobody envies that job. But at the same time, the restoration of price stability and really dampening inflation that has run rampant to this point, that continues to impact household spending propensity, even all the way to businesses and how they're having to restructure some of their costs as well. It continues to be felt across the market, and it's just a question over the course of this year as they begin to either pause or signal some type of pivot in tone that we could see some type of reprieve in the equity markets as well.
Yeah, bottom line, there doesn't seem to be anything market moving in this particular speech. From a policy perspective and more of a big picture perspective, it is interesting that Powell is saying we won't be a climate policymaker. Some of the critics of the bank had sort of leveled that charge that the Fed was, you know, in some of its commentary, either by Powell or other members, sort of strayed into wanting to affect policy when it comes to ESG or green banking, what have you. So it's interesting that he's making those comments, but again, not market moving.
Yeah, there might be a little bit more here than I initially thought. I didn't see much in here, but I will say this. Now we have Raphael Bostic yesterday out here, came out yesterday. Mary Daly, of course, members of the Fed, pushing back on this notion that we are nearing some pivot in Fed policy, really pushing back on rate cuts. I would even argue that what Jerome Powell said today is also pushing back on those things, and that's why you're seeing futures down. All
right, we're going to continue to keep a close eye on futures here this morning as Powell continues to speak in Sweden. We're about 25 minutes to the start of the opening bell, and we're tracking this ticker very closely in the pre-market. BBBY, Bed Bath & Beyond. The struggling Bed Bath & Beyond released its long-awaited holiday quarter results this morning, painting a not-so-pretty picture for investors. Net sales, they crashed 33% year over year, and its comp sales plunged 34%. Brian, I saw you already churned out an article. We got that up on the website here this morning with a few things that investors should be paying attention to.
It's my Super Bowl, Brad. Bed Bath Beyond earnings. It's taking me back to when I covered Sears.
You have a lot of these Super Bowls,
I
I've
do.
noticed.
You know what, Julie? Every day is a Super Bowl for me. Every day. You get excited about something every single day. But I would go, I know I teased 7 stats we had, and if you go to the Yahoo Finance homepage, you will see those stats laid out at the top. But I want to zoom in on this. This company had a 10-minute earnings call this morning. Sue Gove led that call this morning. No analyst questions, really, because there are no analysts left that are covering this company. But inventory, she did note that they are still having problems getting inventory into the stores. What is that doing? That is leaving the shelves bare. And if you look at the company's cash flow statements, last year, over the past 9 months, I should say, they have spent almost $300 million on inventory to keep things in their almost 1,000 store count. Now, they only exited the quarter with $153 million in cash. So they're going to need cash very soon if they're going to want to keep anything on these shelves. And it's unclear. I know Gove said that they're working on potential options in a, quote, timely manner. But where are those options? Something needs to be done because we are now at the point where Bed Bath may not even be able to open its doors to any customers that do show up.
Yeah, the options right now that they had laid out, at least within this release, and this comes after the business update that had, in more dire terms, really pointed out what could happen next, and the business could essentially cease to exist, or at least in the near term have to explore the option of bankruptcy as well. And I did a Control F for bankruptcy the second that this dropped, and you didn't really see it mentioned outside of what was just in some of their disclosures at the bottom of that. But within this as well, they're going to continue with some of the incremental cost reductions, about $80 million to $100 million across corporate, including overhead expenses, headcount, really to try and get the business to align better with where they are right now.
One of the other things I noticed is, amidst all of the options that the company has talked about, not just now, but in past years, was a sale or spinoff of Bye Bye Baby, which had been a better performer within the organization, but it said that comp sales were down in the low 20% range.
Horrible.
So that is not, better. You pointed out to us last night that Babies R Us is going to be revived in the American Dream Mall.
Talk about a well-timed press release from that team over there in the now empty American Dream Mall.
But for that matter, there's just whether you're talking about Bed Bath & Beyond itself or Bye Bye Baby, there was always a lot of competition for this space, and Bed Bath & Beyond actually held up much better. I mean, I actually thought it was so interesting to hear our Dee Thomas talk about what appealed to her about Bed Bath & Beyond in the past and what stopped appealing to her during the pandemic. They just stopped having the stuff that she wanted to buy, right? They had a lot of out of stocks and it never quite got its groove back. And, the customers are just not coming back.
That gets the essence of the outlook for this company, and that is there is none. This company, and I think I've said this before, and you hit the nail on the head, Julie, they stand for nothing. In this marketplace, you can get a Keurig coffee maker, you can roll up to Target and get that, and you can get a full-on refurnish your home with stuff that looks cooler than anything in the Bed Bath & Beyond store, and then secondarily, you can get it all at lower prices. This store worked 20 years ago when there was nothing like this in the marketplace, and I don't care what Sue says on the 10-minute earnings call, there is no turnaround. The stores are just too big. They don't stand for anything. There's nothing differentiating them versus things online. The company will unlikely be around within 5 years.
Well, customers are doing more evaluation in terms of the value experience that they have in purchasing, and then additionally in the quality of the product that they're getting from any retailer right now. And if you have a deterioration of that value appreciation from customers, then they're going to look for some of those alternatives, as you said. And we're going to hear from some of the banks over the course of this week and next week about how they're seeing customers engage with their own spending habits. And I think what Matt Maley told us yesterday from Miller Tabak was extremely telling, because there's not just a demand problem. It's actually the fact that demand is highly reactive to the lowering of prices right now. And so he basically just summed it up saying that everybody is saying demand's fine, but it's not. Demand is fine because they're lowering prices. And so demand isn't fine in that essence as well.
And you nailed it too, Brad, as well. Why is the stock up? You're wondering, why is Bed Bath shares up? But when a company lost this much amount of money, no mention of that one single word, bankruptcy. So there's hope, I think, in this meme stock community, and I'm seeing it just in the tweets that I'm getting, that they will not file for bankruptcy. That's not the case. Just because they didn't mention it like they did a week ago does not mean a bankruptcy is off the table. We could be sitting here in a week or two and talking about a filing from them.
Right. It just seems to mean it's not happening today.
That's it.
Exactly. All right, and let's talk about Coinbase as well this morning. The company coming out, and its shares are up about 1%, coming out and announcing that the company's going to lay off 20% of its workforce. That's about 950 people. And this comes after the crypto trading platform cut 17% of its employees back in June. So this is on top of that. The company also coming out with some preliminary results as a part of this statement, saying preliminary 2022 adjusted EBITDA within negative 500 million loss guardrail, as some would say. In other words, it had set sort of a range of its EBITDA losses before, and it's still within the range that it had set before, it seems to be. But it does talk about fallout from unscrupulous actors in the industry having an effect on the business, acknowledging that the collapse of FTX, the charges against Sam Bankman-Fried, all of that has caused problems for people investing in crypto.
All of that's been a sentiment vacuum, too, for anybody who did want to buy into the thought of what crypto could be within their portfolio, knowing that it has more of a risk propensity than many of the other assets that they may hold, but then at the same time looking at the promise of decentralized finance and trying to hold on to hope that it would gain value so much over an extended period of time. But within this crypto winter and the washout, that washout is taking place among some of these smaller and projects that just didn't have any validation or utilization, and then even in a regulatory framework would have probably been left by the wayside as well. And so I think as they examined some of their scenarios, as they put in the note from Brian Armstrong, that it became clear they needed to reduce expenses, increase their chances of doing well in every single scenario. They just came back to having to reduce their headcount.
You follow the space very closely, Brett. Where's the catalyst for Coinbase this year in terms of the top line? I don't see we're at mid-year 2023, and we're talking about a revenue re-acceleration for Coinbase. So now you can have Coinbase, I think, just obsessed with cutting costs to raise the stock price like we're seeing here today. I would say that this may be just the first or the second round of cost cuts in what might be several rounds for Coinbase.
No, it's a great point. And I think for across the crypto industry, any company that's trying to navigate through this winter or ice age landscape, even as some of our guests have called it, they're going to look across all of the expenses, but then also in their charting a path for how to make it through this crypto winter, it's going to come on the back of where can we see any type of high margin business that customers will continue to flock into as we're trying to educate the broader market that isn't tapped into crypto yet and try to monetize those end users. And we've seen several efforts, but I think even in some of the analyst calls that have been out there, they have said that Coinbase perhaps is in the best scenario to be able to do that. But even they, as the powerhouse that they are on the platform side, still have to make cuts like this too.
Yeah, and we're going to talk to analyst Dan Dolev a little bit later on about Coinbase and his view of it. I mean, to your point, Saz, in terms of what's the inflection here, is it a question of growth or is it a question of stopping the deceleration, right? Do you just get to a place of stability? And that's where, in this environment, I don't know if that's enough, but that's got to be the first step, right, before re-accelerating and growing again.
What major falls from grace is indeed. All right, coming up, recessionary vibes in the economy has sent folks off to scoop up frozen foods and Slim Jims from Conagra Brands. We'll be right back with the company's CFO, Dave Marburger, next. With recession fears creeping into the economy and prices to eat out on the rise, frozen food sales are heating up for Conagra Brands, alongside demand for microwave popcorn and sunflower seeds. Conagra Brands CFO Dave Marburger is in the Yahoo Finance house. Dave, good to see you in person here for a change. So, good quarter for Conagra Brands. Are you just seeing consumers that are concerned about watching their budgets trading down to frozen food?
Yeah, so we had a great quarter. Sales were up 8.5%. Consumption was up over 10%. When COVID started, we had a lot of people that were obviously at home, and we converted a lot of new users to the brand, and that hasn't changed. So we still have a lot of consumers in the brand. We're really pleased with our frozen food sales. We have great brands like Marie Calendar, Bird's Eye, Banquet. All those businesses are up double digits, and consumers are enjoying it. There's a lot of trade down from eating away from home to eating at home, and frozen food is benefiting from that.
And you all talked on the call about an inflection point in your margins, that you're now able to see margin stabilization and even expansion. Are you going into this year, are you going to see the rate of inflation come down, or are you even going to see your costs come down to the point where that margin expansion is going to continue? Yeah,
so if you look at our portfolio, our basket of goods, we got hit early with inflation. So if you go back, we're a fiscal year May company. So our fourth quarter end of May, our inflation really inflected. We were almost at 9%. Fiscal 22, our inflation was 16 to 17%. So this year in fiscal 23, we're guiding to 10% inflation. But that's off of a 16% in the prior year and a 5% in the year before that. So on a 3-year basis, our inflation's about 30%. So when that happens, your costs go up. You have to take price increases, but there's a lag from when that cost hits your P&L to when you can take prices up to the customers. So that's what this recovery phase is. We finally caught up with our price increases to our customers from the cost increases we've been incurring. So we're confident that the margin inflection we saw in Q2, which was about 300 basis points, will continue for our second half.
And that 10% inflation that's still going to be happening, where is that coming from? Because a lot of the food input costs have moderated, right? I don't know what packaging looks like right now, but then of course you also have labor. So talk to me about those different inputs.
Yeah, so about 2/3 of our cost of goods sold are materials costs, so ingredients and packaging. The other third are conversion costs and transportation costs. So when we look at the 10%, we still have a lot of material areas that are up double digits. So things like sweeteners, dairy, vegetables are up. Some other ingredients are only up moderately or even slightly down, things like poultry or beef, but that's off of record highs in the prior year. We've seen a moderation in transportation costs. So they were running double digits last year. They're probably in the mid-single digits right now. And our conversion costs probably high single digits. And that's our labor and overhead in our manufacturing plant. So that's the key drivers of the 10%.
To what extent in trying to manage costs right now, do you have to kind of implement some even shrinkflation measures that customers may experience?
Yeah, it's interesting. We are not a believer in that. So we would rather just put the right amount of food in the product and charge the appropriate price. We find that consumers don't always like that when you try to constantly take food out.
We don't.
No.
Don't take food out of my power bowls, Dave.
That's right.
Don't do it.
Don't worry, Brian. We're good.
All right, I need my cauliflower rice.
But we'll take the price up, and so that's what we've done. And actually, we've seen it. You see the volumes. We showed a chart in our Q2 earnings last week. When you look at over 52 weeks ended November 19th versus 3 years ago, our volumes are flat. That's the best in the food industry. So we've taken our prices up over 20% during that period, but the volumes are flat. Now, period to period, you kind of get some swings, but that's really a support of the investment we've made in our brands, the innovation. I don't think that would have happened in this portfolio 10 years ago.
Dave, last night I was joking with the team that I did have 2 power bowls, and I got them from Target, about $4.50 each a pop, and they didn't taste bad. I mean, you think frozen food still gets a bad rap? It's just you're opening a pack and it tastes like crap.
You know, Sean always talks about it. You know, frozen is a temperature state, but for years companies would just cheapen the food when it was in frozen. So there was this perception that frozen food is bad. Frozen food is actually very good, and that's the key to our strategy of driving frozen. We want to put good food in there, flash freeze it so it's ready when you're ready. And the quality's great. I eat a lot of power bowls. I mean, the Marie Calendar stuff is great. So I have 3 kids that are, in their 20s, and they all eat it, and they're coming to me, and they don't have to, and they love our Healthy Choice products.
You got a fan in me in that brand, but you got also pressed on the earnings call a little bit, Dave, about the snacks business, and maybe it's not getting the valuation it deserves. Have you run the numbers on that, on what it could be worth, and is it time to consider a spinoff?
Yeah, so it was a good question. I thought Sean gave a great answer on that. So we always talk about we're perpetually looking to modernize the portfolio for better growth and better margins. You can do that organically with the CAG way, which is us driving innovation. You can also do it inorganically, right? If you look at this company since 2016, we've sold or spun off over $7 billion worth of business. So we're not shy when it comes to shareholder value and maximizing value. The point Sean made, which was a really important one, is when you have a portfolio and you decide to maybe sell or spin off a big portion of that, you really need to understand stranded costs, right? Because if you're not going to be able to transfer certain costs, they just stay with the remaining business, and that can dilute margins of your base business, and then you don't get the multiple expansion that sometimes you expect. So we look at that all the time. We're constantly looking at both acquisition opportunities and ways to think about the portfolio, and we'll continue to do that.
I want to ask about Gardein randomly. I saw the video there we were showing of the product, because that version of plant-based meat has been around for longer than some of the newer entrants like a Beyond or Impossible. The pure play publicly traded Beyond Meat has collapsed, right, and has seen a lot of demand issues. What are you guys seeing in Gardein? What is the next phase of the plant-based demand journey, if you will?
We're pleased with Gardein. If you look at it on a 3-year basis, I think our consumption growth is up over 30%. So we made a decision not to compete in fresh, not to compete in food service in any big way. We're frozen, that's a core competency. So Gardein is a brand that competes in frozen food. So all of our core Gardein products you see in the frozen aisle, and frozen continues to grow. And so we didn't kind of say we're going to expand this into all different kinds of away from home channels and refrigerated. We stuck with frozen, and we're sticking to that focus, and it's paying off for us.
Conagra Brands CFO Dave Marburger joining us here on set. Thanks so much for being kind enough to take the time live and live in color with us.
Thank you for having me.
Appreciate it. Guys, coming up, shares of Virgin Orbit, they're crashing back to Earth. We're going to discuss that, plus the opening bell on Wall Street. That's next. Still some time till the opening bell. Let's take a look at what's moving here this morning. First, we got to check in on shares of Broadcom. It's the ticker symbol AVGO. That's moving lower this morning, fractionally lower right now by about 0.5%. That's following a report that Apple will stop using Broadcom's chips in its devices by 2025. According to Bloomberg, Apple expects to shift into manufacturing their own chips by the end of next year. Apple had kind of signaled this a little bit more with the way that they were moving and how they were structuring some of their partnerships, especially with one Qualcomm as well. And so on the chip side, this is something that's been kind of in the cards for Apple. It's just a matter of how swiftly they were going to put this plan into motion as well.
Right. That might be why we're not seeing more of a reaction in Broadcom or in Qualcomm for that matter, because the reporting also says that the modem chips that Qualcomm makes are going to be moved away from by Apple. Interesting in terms of how much this accounts for in Broadcom's sales line. According to Wells Fargo, it's 20% of Broadcom's total revenue, or about 85% of the company's wireless segment revenue in fiscal 2022. So it's a big chunk, but the company is also aware of it and trying to look for other sources of revenue.
Yeah, and they have been. You look at them acquiring VMware. You look at them also a couple years ago buying CA Technologies. You can argue that longtime CEO Hock Tan has been seeing this day coming for a long time from Apple, and he's been trying, to your point, Julie, diversify that business.
Right. It's more about vertical integration for them, too, and how they cut costs even in kind of that next wave of the super cycle that they may anticipate for handset devices and even for computer devices. And if they're taking more of that manufacturing of the chip under their own helm, then that could help them kind of trim some of the fat in terms of their cost basis as well that they currently have.
Right. There's sort of two sides to this story, right? There's what it means to Apple suppliers, and then there's what it signals to us for ongoing Apple strategy as it tries to at the same time gain more control over its supply chain by making more of these chips in-house, and also diversify its supply chain, as we've been hearing recently, moving more into India manufacturing from China and Taiwan manufacturing, for example. So it's quite interesting, just the two sides of that and what Apple is going to look like a decade from now or even 5 years from now in terms of its manufacturing process.
Well, it will still have to have key partners like this, I would imagine. I get they're trying to put their whole supply chain in-house, but if you come out with an Apple car, whatever that might look like, maybe it's just technology that goes onto a self-driving car, you come out with AR, VR glasses, that's more product lines, more chips you're going to need.
Well, it seems like they're going to try and circumvent the manufacturers themselves and perhaps just drum up more materials partners on that front too, as long as they can figure out how to do some of the nano production that's necessary for these chips too.
All right, well, we got the opening bell coming our way in just a few seconds here, and futures have been trimming some of their declines as we've been getting closer to the opening bell, but it looks like we could still end up in the red. We've got the Manhattan Borough Commissioner ringing the opening bell here this morning, John Rain, as we get underway. We had a positive start to the year. If you look at the first 5 trading days of the year, that tends to augur how the year is going to be. We had gains overall in those first 5 trading days of the year, so we'll see.
Look what happened.
We'll see what that means. And yes, we have a little bit of a decline thus far in today's session, but we'll see. And, the comments from Fed Chair Jay Powell, the published comments, I believe he's either hasn't begun to speak yet or he's about to begin to speak in Sweden, not really having anything market moving necessarily, sort of just re-emphasizing, defending what the Fed has done before.
Bleh.
Bless.
Bleh.
Snoozle,
Bleh.
as Guy Labat over at
French?
Jenny Montgomery Scott
I'll put you
tweeted. Snoozle was
Love
his description of it. And there it looks like we have some of that commentary happening over in Sweden. We'll see if we get anything from the Q&A. Maybe that will
There's our guy, Lord Mervyn King, friend of Yahoo Finance. Good to see him up there rocking it.
All right, well, we'll see if investors deem this a nothing burger or if it's a something that comes out of Fed Chair Jay Powell as he speaks in Sweden. Taking a look at the Dow Jones Industrial Average here on the morning. That's flat, just barely to the downside, so we'll keep a close eye on that. Just 5 points lower here out of the gate. Nasdaq Composite, you're seeing that in the red as well. For the tech-heavy average, it's down by about 0.2%. We'll round that off to just about 16, 17 points in the red. And then the S&P 500, you're also seeing that down by about 1 point. Let's give you a view of this chart while populated. Over the past 4 days, it's higher, net higher by about 1% for the S&P 500, and then the Nasdaq Composite and the Dow Jones Industrial Average, as the S&P just barely slips into, or actually makes a move into positive territory, so does the Dow. That is now higher. So some early day hyper waffling we might see here. We'll see exactly where things start to really gain some momentum and settle here. But as of right now, just flat for the Dow and the S&P 500 and oscillating. But also taking a look at some of the sector activity that we're seeing early in today's trading session. We are mixed right now for the 11 S&P 500 sectors. Energy is the leader. That's up by about 0.7%. However, communication services, you're seeing that pull up the caboose. It's down right now by about 0.5%. Let's take a look at the Nasdaq 100 here. And for those mega cap tech stocks out of the gate this morning, at least, you've got Apple fractionally higher. We were just discussing some of the moves there with regard to its chip manufacturing ambitions in the future. Amazon, that's up by about 0.9%. Microsoft, you're seeing that catch a bid to the tune of about 1%. And then Google, or Alphabet, you know what I love to say, Alpha Google, right now down by about 2% out of the gate.
Alpha Google, hyper waffling.
Hey.
We like all of your catchphrases. I'm a big fan of the Brad Smith catchphrases. Let's take a look at shares of Virgin Orbit after an unsuccessful first attempt to send a satellite into space outside of the U.S. The rocket, which was holding 9 small satellites, reached space, but then experienced what the company called an anomaly before it could achieve its target orbit. So essentially, the launch failed. And so that's why we are seeing the stock tumbling here this morning. And, you know, when you look at the new space race, as it were, you have, of course, the commercial space race, and then you have the commercial space race, meaning normal people flying to space.
Tourism,
and then it's tourism, thank you. I was searching for the word. And then you have satellites being flown to space. And, you know, in this industry, this is really a big setback for the company. That's reflected in the shares today.
Yeah, I was looking to see if that is the same stock price as Bed Bath & Beyond right now. What, $1.50 for Virgin Orbit? Bed Bath & Beyond shares, $1.70. Race, big race to the bottom.
Well, it's the cost basis for each of these launches. It costs about $12 million to launch one of these flights. And so for Virgin Orbit, that will directly impact how investors are looking through the number. You're laughing, but it's so real as we're trying to get a Bed Bath & Beyond comparison in there.
Gotta hit that ticker, man.
Yeah, but for Virgin Orbit and the costs that can really rack up if these do not go according to plan, I think that's a stark reaction that investors are very swift with after they see a failed launch to this magnitude as well.
All right, from space to healthcare. Shares of Illumina in focus after issuing weaker than expected guidance for 2023. That would be this year. Company expects to earn $1.25 to $1.50 a share, while the street was estimating over $3. Woof, Julie. Not a good outlook from this company.
Yeah, no, not a good outlook from this company. It makes genomics analysis equipment. So this is an industry that's really come a long way, obviously, and the machines are much more used than they were. However, obviously, this is disappointing versus what analysts were looking for. And there's some talk here about the company's deteriorating earnings power. That was some commentary from Citi analyst Patrick Donnelly, who actually has a sell rating on the stock, and he says the first half of this year is going to be particularly soft. The company's also seeing some obstacles. It's been trying to buy a company called Grail for $7 billion. That's been undergoing some regulatory scrutiny, including from the European Union. And by the way, the CEO of the company, Francis Sousa, made these comments in this new forecast at that JP Morgan healthcare conference that's going on out in San Francisco. A lot of healthcare news and market-moving healthcare news tends to come out of this conference, so we're going to be watching to see if there is any more on other companies. But in the meantime, it's not good news for Illumina today.
Yeah, within that presentation that they had outlined this total addressable market, this TAM penetration of about 7% that they currently have, and $120 billion is what they're putting on this addressable market. And so within that, oncology testing really making up the brunt of that, or the lion's share of that, at about $78 billion worth of that total addressable market. So we'll see how they continue to do more research development and put products, solutions out into the market to really get that monetized as well. Also, coming up on the other side of this short break, Taiwan Semiconductor was hit with its first quarterly revenue miss in 2 years. Yahoo Finance's Inez Ferrer is going to have the deets next. Welcome back to Yahoo Finance. We are taking a look at the major averages here this morning, where we started off negative out of the opening cross, but ultimately right now we are higher, at least at 9:38 a.m. Dow, S&P 500, and the Nasdaq all in positive territory. Let's get on over to Yahoo Finance's own Inez Ferre with more on today's early activity. Inez?
Yeah, that's right, Brad. And just taking a look right now at where we're at with the sectors, consumer discretionary, energy stocks, those are seeing a little bit of gains. The Dow, we are watching Microsoft up more than 1%. You've got Boeing that's down more than 1%. Boeing was downgraded at Morgan Stanley. Also looking at the Nasdaq 100, Amazon and Tesla are higher. We have been watching the semiconductors. You were just mentioning before the break, Taiwan Semiconductor and its revenue, which came in as a miss for its latest quarter. You know, we have seen this story over and over again with the semiconductors, with the chip makers talking about a global slowdown with the price of chips that are falling, with businesses and consumers that are pulling back on electronics. You had a big pull forward during the pandemic. And so now we are seeing a bit of a slowdown when it comes to the chip makers. I'm going to pull up a one-year chart so you can see the chips charts for a one-year chart. But today we are seeing a little bit of a bump for some of these chip makers, guys.
All right, Nestre, thanks so much. All right, C-suite execs are growing worried about the outlook for economic growth this year, and it shows. Big name companies such as Goldman Sachs, Amazon, and Salesforce have announced mass firings this month, and these execs and others could be eyeing more cost cuts, judging by their words on various conference calls. The chart here from Morgan Stanley shows a spike in the term efficiency on conference calls, a surefire signal execs are clamping down on costs and want to signal those costs, potential cost cuts to Wall Street. Coming up, why our next guest says we're in a good environment for bank stocks. We'll discuss next.
are about 13 minutes into the trading day today, and stocks are hanging on to some modest gains right now. Investor concerns over higher rates, though, are still at the core of the outlook for 2023. Federal Reserve officials point towards the likelihood of interest rates rising above 5% as Jay Powell defends the Fed taking measures that are not popular to rein in inflation. For a closer look at the market reaction, we have Jackie Kavanaugh, Putnam-focused equity fund portfolio manager. Jackie, welcome. Thanks for being here. We heard Jay Powell talk this morning over in Sweden. He didn't say a heck of a lot that seemed to move the market, except from just saying we're staying the course effectively. So just first of all, I guess, give us your big picture view for 2023 and what that's going to mean for stocks.
Sure. Thank you, Julian. Thank you for having me. Yeah, I wouldn't expect Chair Powell to say anything during his prepared remarks, as you mentioned earlier in the show. I could see him saying potentially something defending his stance during the Q&A, so that'll bear some watching. I do think, though, as we think about what we're facing for 2023, we think it's going to be a tough year, particularly the first half of the year. You know, the Fed continues to signal that their terminal rate is likely to be north of 5%. You had two Fed governors out yesterday discussing this, and yet the market is fighting the Fed. I mean, the 2-year continues to hover at like 2.42, 4.3. The 10-year is trending at 3.5, and this is just not what the Fed wants to see. And so while he is saying that some of the moves will be unpopular, are likely to lead to some job losses, they view it necessary to rein in inflation. And the real place that they have to get at is wages and wage growth. And so the jobs market remaining so tight is really problematic for the Fed. So we think the terminal rate is probably 5 or north of 5. And then we think we sit there for most of 2023. And they just wait for that jobs market to loosen up and to take the risk of a wage price spiral off the table, which is what they're really concerned about.
What do you believe valuations need to come down to as we're kicking off this next earnings season?
Yeah, so if you've gone back and look at prior recessions and prior market bottoms, what you typically see is that, you know, obviously the GFC and the tech bubble were anomalies. But when you look at a garden variety recession, which we think is what you're facing here, either a slowdown or a very shallow recession, we would think about an S&P in sort of the 15 to 16 times range on a forward multiple. When I last checked, I think it was trading around 17.5 times. So we do think there's still some room for some, let's call it 10% margin compression. Where I think you still have some risk, though, as well, and you were talking about this earlier, is I still think you have some earnings areas that need to take some cuts, where you're going to see some downward earnings revisions, maybe coming out of Q4, and then continuing as we progress through 2023. You know, you certainly saw Lululemon earlier this week. They took a hit at their guidance. Illumina, you were mentioning. We expect you'll continue to see some of that over the next earnings cycle of Q4.
Jackie, the difference between the yield on the 2- and 10-year Treasury note, it's at its widest in about 40 years. And to some, that's a surefire recession signal. I mean, as you take a step back, do you think something like that all but guarantees a recession this year?
So, you know, that is an interesting metric, and it's certainly one that we track, the yield curve inversion, and it has historically been an indicator. It has indicated every recession, that is true, but not every yield curve inversion has led to a recession. So I hope you understand that distinction, right, which is that just because it's inverted doesn't necessarily mean recession, although every recession has been preceded by an inversion. We think here, though, you are likely to get a recession. It may be very shallow. I don't think it's going to be a cataclysm like we had in the GFC, but we do think a recession is the most likely outcome. They're trying desperately to engineer a soft landing, and you are getting pockets of areas where inflation is really starting to help them out, particularly on the good side. But services inflation just remains really strong, and that's driven by the labor market. And the labor market, as you know, is at a 50-year low on unemployment and just remains incredibly tight, with job openings still 2 to 1 versus people available for jobs, people who are unemployed. And so that needs to loosen for the Fed to be able to declare victory here.
Jackie, I know you like the banks here, and so I want to delve into that a little bit because on the one hand, rates going up tend to be good for banks. On the other hand, even if we're not going into recession, even if we just see weakening economic growth, that doesn't tend to be so great for the banks. So how do you see them threading that needle?
Yeah, so I think you've hit the nail on the head, Julie, which is that on the revenue side, higher rates and the longer duration of higher rates is clearly a positive for the banks. And we don't believe the duration of higher rates is really in. Everyone knows rates is going up, so that is in the bank forecast. What I think is underappreciated is how long we're going to sit at higher rates, and the duration of those higher revenue lines for the banks is going to be longer. You're right, though, that comes with a cost, and the cost is usually expressed through the credit line and through credit losses. I think the thing you have to remember here, though, is that credit is coming from an unbelievably strong place. I mean, we are so far off of historical credit averages. We're still near all-time lows in terms of credit losses and credit delinquencies. So you will get normalization. You will get weakening, particularly if you have job losses. But we think that's going to be very manageable for the banks. In fact, most of the banks, when you talk to them, they're already provisioning for a 5% unemployment rate, which we think feels about right. So you have the benefit on the top line of higher for longer. You have credit costs which will rise, but which will remain very manageable. And then you have valuations where virtually all of the banks, not all the regionals, but the bigger banks are trading below their historical price to book averages. So we actually think it's a very good setup for the banks. I think it's going to take time for people to appreciate that the duration is longer so that the earnings duration is longer for the banks to re-rate. But we think it's a very attractive segment within the market today.
Jackie, in recent earnings periods, we've heard banks say that the consumer is resilient and then say that the consumer is healthy. This earnings period, how do you expect them to classify the sentiment among consumers or the health of consumers?
I think the data and the facts support that the consumer remains very healthy. You continue to have over $1 trillion in excess savings versus where you were pre-pandemic. The consumer remains in a strong place in terms of excess savings. The consumer has a job, which gives them confidence to continue to spend. They have confidence if they lose their job, they can quickly, maybe not easily, but quickly replace that job. So I would expect the characterization of consumers and earnings this quarter to remain reasonably strong and pretty robust. You know, ability to spend, money to spend, and desire to spend. I think where you could start to see some caution is on the outlook, right? As you start to see, you know, increasing job, obviously we had the Coinbase announcement this morning, increasing job losses, headlines around increasing job losses, which does drive confidence issues in the consumer. So the outlook might be weaker, but I think the data this quarter is very clearly going to support a consumer that remains very robust and very resilient. And again, you just don't see any cracks on the consumer credit numbers at all. Some slight tick-ups in delinquency, but really remain very solid.
Interesting. Well, we'll see what gets borne out in some of the corporate earnings as well. Jackie Kavanaugh, Putnam-focused equity fund portfolio manager. Great to catch up with you this morning. Thanks.
Thank you.
Coming up, Netflix shares are in the green so far in 2023. Saz is going to share his take on the streaming giant next. Netflix shares have been climbing in the first few days of 2023. The moves caught Brian Staszi's attention. He says the momentum could continue. That's where we find a stake today.
Right, we're 10 days into the new year. Netflix shares are rocking, Julie.
It hasn't traded for 10 days.
Well, they're ripping higher. The stock's up about 9% so far in January. That's the point I'm trying to make here. Up 70%. Believe it or not, in the past 6 months, Netflix shares absolutely on fire. So let me decode why I think you're seeing some of these moves in the stock. First, earnings power unlocked from the new ad tier. A lot of optimism on the street on how much revenue, how much in profit potential this company will pull out this year and then moving forward because of this new ad tier. Really interesting note by the JP Morgan team earlier this morning. They're out there raising their estimates in large part because of this new ad tier. Next up, in late December, the new executive compensation structure at Netflix hit. Basically, Reed Hastings is among other executives at the company taking a more shareholder-friendly approach. I believe will not be paid a salary. Essentially, his earnings will be tied more to share-based compensation. Of course, that would theoretically incentivize him more to perform better on the top and bottom lines, whatever that might entail. Next up, buzzy releases, something that this team always talks about, the latest Netflix releases. Glass Onion, Troll, All Quiet on the Western Front, My Name is Vendetta, and of course, Wednesday, all off to a good start, according to JP Morgan this morning in its note. And then also, JP Morgan also highlighting or surfacing some new data out of Apptopia. Netflix download trends improving. We have that chart here. You can actually start to see some of the download trends improving right there below my big fat face. You can see that trend starting to improve incrementally, those downloads for Netflix in large part because of some of those new titles that are getting favorable reviews there. So that is a good thing. Now, Netflix reports earnings on January 19th, a couple days away for that one. One number to watch always with Netflix, but especially this time around, given how far the stock has run, is net additions. The street is looking for around 4.5 to 5 million new net additions for Netflix. Netflix's guidance is for 4.5 million. So the street's expectations are very, very high into this report, raising the bar for what Netflix has to deliver and then also ultimately report on their earnings call. My take is this. On the earnings front, if Netflix does not have that perfect earnings day, which includes strong execution on the financial statements, notably the net additions, but also a strong earnings call, you could see a little bit of a pullback in Netflix shares just based on the strong run we have seen the past 6 months, and Julie, and of course, year to date.
I saw you were watching Harry and Meghan there on the screen on your tape.
I'm hooked. I've watched it actually twice.
Really? You're going to read the book too?
Watch the whole thing
I like
twice?
it. I'm a little bit of a royal geek. I dig it.
Would you read the book? Are you going to get the book?
No, time for that. I just watched that, and I watched the Anderson Cooper interview on 60 Minutes.
Excuse me. Yeah. You watched the whole series twice, and you don't have time to read the book?
I don't want to read the book. I read enough financial statements and Bed Bath & Beyond earnings. I don't want to read more stuff. I just want to relax. Julie.
By watching the Harry.
I don't want to read. I don't want to read it.
Right. Well, certainly on the titles, they did crush it last quarter, and we'll see if that shows up in some of the numbers that are expected by the street. Coming up on the other side of this short break, we're going to break down the latest market action with Eagles View Capital Management's Neil Berger. That's next.
Boop, boop. Hello, and welcome back to Yahoo Finance. I'm Brian Sozzi here with Julie Hyman and Brad Smith. Markets, well, we're seeing a little bit of muted action as traders await key CPI data later in the week. Right now, we're seeing all three major indices. Really, they started off in the red. Right now, we're seeing some gains across the board. And here's what's on tap this hour. Big call on Microsoft. We'll talk with one Wall Street analyst who sees a big move in Microsoft based on its exposure to ChatGPT. And the axe swings again at Coinbase. The struggling crypto outfit is firing more people. We'll chat with a Coinbase bear on what to expect next. And upbeat restaurants sales continue. We'll look at some fresh numbers out of Shake Shack as it presents at a key conference today. Brad, over to you.
All right, taking a look at the major averages here. We're just about 31 minutes into trade on the day. The Dow Jones Industrial Average holding on to gains, and you're going to see a similar theme across all of the charts here this morning for the U.S. major averages. Dow up by about 0.1%. Nasdaq Composite up by about 0.25%. And the S&P 500, you're seeing that at by about 0.1%. And the technical traders out there will note that that is forming a solid waffle pattern right now. So we'll continue to track that as we move on and the markets make up their mind today as we're still kind of listening into some of that commentary from Fed Chair Jay Powell that's taking place in Sweden today. Let's also take a look at the Nasdaq 100 here this morning, where you're pretty mixed here on the day. Let's just give you a good view of the heat map here. Looks like more advancers than decliners here on a broad basis for the Nasdaq 100, being led by one WBD up by about 4.4%. So Warner Brothers Discovery and all right, so you see it there. Anyway, and then a company that we were talking about a little bit earlier, Illumina, you're seeing that, or Lumina rather, that's down by about 6.25% here. And then additionally, Broadcom, we were breaking that down and that being impacted by a move by Apple to really rein in some of its own vertical integration with regard to its chip manufacturing ambitions. So Broadcom being affected by that. Let's also take a look at the sector activity here right now. For the 11 S&P 500 sectors, we're seeing utilities bring up the rear. It's down right now by about 0.7%. However, XLV up 0.5%. Healthcare doing well, looking healthy today. So we'll continue to track that very closely as we move on throughout the rest of today's session. Switching gears here, Fed Chair Jay Powell out with some comments this morning on why it will continue to take a hawkish tone on inflation. This from a speech at Sweden's Riksbank today. Take a listen.
Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy.
So joining us now for more, let's bring in Neil Berger, who is Eagles View Capital Management founder, president, and CIO. Neil, great to have you here with us this morning. In your notes, you actually said that the world is seeing a unicorn for the first time in 40 years. Help us break that down as you've got central banks really undergoing this balance sheet normalization, as you call it.
Sure. Thank you for having me, and good morning. Inflation has been talked about certainly during my career, which spans 33 years in the investment business as both a trader and a hedge fund allocator. But I have actually never seen inflation. I know that it existed 40 years ago, but I think for the generation that is investing today, it's somewhat of a unicorn in the sense that we've heard about this thing that exists called inflation, but we've never actually seen it in practice. And now we're actually seeing it, come to the fore around the globe, not just in the U.S. And, I believe that it's an artifact of the massive liquidity infusion, the central bank's posture towards liquidity by injecting $25 trillion into the system, initially since the global financial crisis, and then more recently in response to the COVID pandemic. And it's created a collateral effect initially of massive asset price inflation, and then more recently, the secondary collateral effect being consumer price inflation. So we're seeing it. It's debatable about whether it's 7%, 6%, 5%, but the reality is it's much higher than it had been during my trading lifetime, and we'll see how that ends up playing out.
We will see how it ends up playing out. Neil, one of the reasons we're talking to you is because your fund that you launched in April 2021 reportedly went up some 163% last year. What you're describing now in hindsight seems like the consensus view. It wasn't always, of course, over the course of the last year. What do you think that investors are still not getting about this big shift that we have seen?
Well, I think that one has to, I think number one, investors are possibly missing a bit of the forest through the trees in that we are in the midst of a major bear market in all asset prices. So to me, the price action is the Bible. If anybody pulls out a chart of the S&P 500 or, bond prices or the prices of crypto, or for that matter, the prices of rare watches, whatever one wants to point to, they're all essentially in a 45-degree angle to the downside for the past year. So I think there needs to be a recognition that that we are in this bear market, and the price action is dictating that. Now, I think that the reason for that, and the fundamental thesis as to why I started the fund, was that one has to believe that we were where we were a couple of years ago, whether it be private equity valuations, public equity valuations, sovereign $19 trillion of sovereign debt trading at negative nominal interest rates, and all the COVID pandemic economic activity screeches to a halt, and the S&P skyrockets like a rocket ship. I mean, these just aren't normal conditions in any universe that I'm aware of. And to me, this is all a result and a collateral effect of the massive liquidity infusion by the central banks, which created a tailwind towards asset prices. And now that central banks are changed their posture 180 degrees towards going from liquidity infusion to liquidity extraction, that provides a headwind against asset prices in the same way it provided a tailwind for so many years prior.
Neil, so do you think this bear market could last another 5 years?
Anything is possible. I'm not in the prediction business. I'm in the observation business. I'm going to follow market price action. And, I never would have imagined the bull market would have lasted as long as it lasted, or had gone as far as it had gone. But, as long as the price action of the markets continues to suggest that markets are going down, I'm going to have to continue to play it that way. And if the market tells me differently, then I'm going to act accordingly. I am not, I'm not in the being right business. I'm in the money making business. That's what my investors task me with, and so I'm trying to avoid predicting where the world is going and just observing. And as the market changes, I'll have to change. But the market's done nothing wrong, nothing right at this moment, as far as I'm concerned.
So in as much as you can tell us, Neil, how are you making that money? How do you, if we're in the midst of this bear market, which we clearly are, given what we've seen over the last year, how do you make money in that environment?
So, I'm short the market. I'm short the S&P 500. I'm short 10-year notes. I'm short Bund futures. I'm short the Euro stocks. I'm short the JGBs. So I'm actively trading, because I've been a trader for 33 years, trading from the short side. My vehicle of choice happens to be futures. It's extremely liquid, extremely deep. I can move around the positions very well. So I'm trading a center book where I'm trading from the short side in these major market indices, global stocks and bonds. And that's how I've been able to create the returns that I've been able to create.
Neil Berger, Eagles View Capital Management founder, president, and CIO. Thanks for coming on Yahoo Finance. Appreciate it.
Thank you. Thank you for having me.
All right, before we head to break, let's highlight shares of energy drink maker Monster ahead of a key January 17th Investor Day. Evercore ISI analyst Robert Ottenstein is looking to hear more from management on the innovation front, notably a new drink dubbed Beast Unleashed, and how it plans to respond to clean energy drink brands such as Celsius.
Have you put in your order yet?
Yes, I have, Julie. Ottenstein is rolling the dice into the event with an outperform rating on Monster, despite voicing some concerns on near-term profit margins and the caffeine in that drink.
Just having visions of role models all over again. Let's kick it off on.
In other words, moving forward. Coming up, CVS is considering another big acquisition. Julie is back with more on that and a look at today's top headlines next.
Here's some other headlines that we're watching this hour. Drugstore operator CVS could be looking to expand its reach in the primary care market. Bloomberg News reporting the group is in negotiations to buy Oak Street Health for over $10 billion. That report sent shares in that company soaring. You can see it's up almost 30%. And the news coming just hours after CVS announced a partnership with Carbon Health, a San Francisco-based urgent and primary care operator. CVS's efforts to grow its business offerings are no secret. In 2018, it bought insurer Aetna, and just last year paid $8 billion for home health care provider Signify Health. That acquisition is still pending. Fisher-Price has re-announced a product recall first issued in 2019. Rock-and-play sleepers for infants were taken off the market 3 years ago after 30 children were reported to have died after rolling from their back to their stomach or side during use. The update comes after at least 8 deaths are said to have occurred since then. The recall applies to 4.7 million sleeper products sold at the likes of Walmart and Macy's. And the death toll from a series of storms that struck California has risen to 14. Around 90% of the nation's most populous state is under flood watch, and over 100,000 people remain without power. Residents of the wealthy town of Montecito near Santa Barbara have been told to evacuate, with 8 inches of rain falling over a 12-hour period. And speaking at a press conference yesterday, Governor Gavin Newsom said the worst is still ahead. Saz?
All right, we're switching gears now to the media sector. Lightshed releasing its top 23 technology, media, and telecom predictions for the new year. From Disney and Hulu to Netflix and the box office, there's lots to discuss. Lucky for us, Yahoo Finance media reporter Ali Cannell is here to break it all down. Ali.
Hi, Saz. Yeah, so I think it's important to remember that 2022 was a really brutal year for media stocks. The stock market wiped out $500 billion from some of the top media and telecom companies. So we're really entering 2023 in this fight or flight mode. So Rich Greenfield, he's a partner at Lightshed. He released some of his predictions. One in particular that stood out to me centers around Bob Iger. He believes that Disney will extend Iger's contract to 2027. He says ESPN is not the biggest problem for Disney. Rather, it's their content creation. And Disney really hasn't had that superstar animated Frozen hit in quite some time. And that Iger is really needed to be there, and that Disney will ultimately realize that 2 years is just not enough to, 1, reinvigorate that content, and 2, find a new CEO. But one thing that Iger will probably have to address is the future of Hulu. Greenfield predicts that, yes, Disney will buy out Comcast's 33% stake in the company, and analysts have been a little split on this. Some have said really Disney needs to figure out their strategy with Hulu and really their overall streaming business, because they really could get a pretty penny if they were to shop Hulu around. That could help out their balance sheet. But for now, the consensus seems to be that Hulu will be bought by Disney. And then on the park side, Guggenheim was out with a note this morning that said that they expect renewed park growth in the first quarter of 2023. That has to do with increased travel at TSA checkpoints. The park experience app downloads have been increasing as well. So despite this pullback that we've seen in consumer spending, macroeconomic challenges, still a lot to be celebrated with the parks business. And then if we take a look at Netflix, Greenfield said that he expects revenue to reaccelerate into the high teens. That's due to the ad-supported tier. That's due to the crackdown on password sharing. The fact that a lot of these other streaming competitors are going to have to increase prices in order to make up from losses. So something to watch there. And then finally, on the M&A front, big prediction from Greenfield that Pinterest will be sold. He said that's really going to be the big major deal this year. We will see. Obviously, sports has been a big topic of conversation. The WWE was a big one last week, but Greenfield said that WWE will not ultimately sell, at least right now. So a lot to dig through, a lot to look forward to. But 2023, I think, is going to be this make or break year for the media sector as a whole.
Could see some fireworks for sure here. There's also been a lot of renewed optimism over the box office, and that coming after the success of Avatar, Way of the Water. Can it bounce back to those pre-pandemic kind of coveted levels in 2023 at the box office?
The general vibe that I'm getting from analysts is that it's going to be a better year than 2022, but whether or not we're going to reach those pre-pandemic 2019 levels, I don't think that's going to happen this year, and it might never happen. That doesn't mean that there's no place for the box office. I think there are certainly movies that consumers do want to go and see in the theater, but that could mean that other things could change. We could see some joint theatrical partnerships. Greenfield predicted that in 2023, the box office will hit 8.5 billion. This year, we've reached around 7.4 billion, so significantly more, but still 25% below pre-pandemic levels. So I don't think we're going to get any hard and fast answers in the new year, but maybe in 2024, 2025, that could change.
All right, we're going to be keeping close tabs on and perhaps seeing some movies at the silver screen. Yahoo Finance's own Ali Canal joining us to break it all down in the media landscape. Thanks so much, Ali. Coming up, everyone, we're going to speak with the analyst that says ChatGPT is a once-in-a-decade opportunity for Microsoft. That's coming up next. Microsoft is considering investing as much as $10 billion in ChatGPT creator OpenAI, according to Bloomberg. Our next guest says the tech giant's incorporation of ChatGPT into Bing could be a once-in-a-decade opportunity to upend Google's dominance. D.A. Davidson Managing Director Gil Luria joins us now. Gil, make the case for why this could be a once-in-a-decade, once-in-perhaps-a-generation investment opportunity for Microsoft.
Well, if you think about where Google's market cap comes from, their 1.1 trillion, almost 60% of that comes from their search business. So, and that's because Google search is so much better than Bing. It's 10 times bigger business than Bing. If incorporating ChatGPT into Bing makes it competitive with Google search, that's the amount of market cap that Microsoft could take away from Google in the order of magnitude of 600 billion. In the short term, Microsoft is benefiting greatly because all this data and computing power is going to its Azure cloud hosting business. And so it's money that they're investing that's coming right back to Microsoft to grow its most important business, the Azure business. So it's a great investment for Microsoft in a product that could really help it transform its two key products.
I mean, Gil, some would ask why Bing even still exists, right? I mean, it's definitely, like, also Rand doesn't even begin to cover it. Google's a verb, Bing is most definitely not. So if you could just walk us through it in a little more detail, like what would a ChatGPT integration into Bing look like, and why would it be such a compelling offering?
So when you use generative AI like ChatGPT and you ask a question, you get an answer. You get a thoughtful, well-articulated answer. When you go to a search engine today, whether it's Google or Bing, you don't get an answer. You get a list of websites where the answer may or may not be, and you have to continue doing the work. That really changes the nature of how we get questions answered. And if you've played with ChatGPT at all, you know that it can answer a very wide range of questions in spite of the fact that technology is still developing quickly. So there's an opportunity here for us to completely change how we find information. We've been Googling for 20 years, and now we may be in a situation where we no longer Google. We ask a question and we get an answer.
So you think, Gil, Bing takes down Google, and do you think Google is working on something like this?
Oh, absolutely. Google's working on a product called Lambda that should be able to do the same thing. But what we're hearing is that it's not quite as good as ChatGPT yet. And so that's one aspect that gives Bing this opportunity to be competitive and take significant market share. And then the other aspect of this is that Google relies on its current advertising business model for almost its entire business. Again, 57% of its revenue comes from advertising through Google search. If they were to change the way we do search to start answering questions instead of giving us a list of websites, that would very much disrupt their business. So Google will encounter the classic innovator's dilemma. Do they destroy their own business in order to stay ahead, or do they try to slow down progress? If they try to slow down progress, that gives Bing that inner run into the ability to gain market share.
How long does it take for Microsoft, if they're successful with ChatGPT, to upend the mind share that initiates every search on Google because of just how long that has been kind of verbified into our daily activity and kind of standard operating practices on a human basis right now?
We're going to find out very soon. Some of the reports out there is that Bing is going to be incorporated with ChatGPT as early as March. And so we're going to see how much better of a product it turns out to be. But if you think about 15, 20 years ago, when we all started using Google, it happened all of a sudden. We were using other search engines. And once Google became better, everybody started using it for everything very quickly. If there is a better search engine out there, if Bing plus ChatGPT is in fact better than what Google has to offer, people will switch very quickly.
So, Gil, putting this all together, there have been reports that Microsoft is thinking about investing more in OpenAI, which is the parent company of ChatGPT, maybe $10 billion over a matter of years. It sounds like you think that would be a fantastic idea. I wonder what you also think of the idea of if Microsoft just bought it outright.
Well, I'm not sure that's a possibility for them. I think the other investors are quite prominent as well. Peter Thiel, Elon Musk. They may not want to sell the whole thing. If Microsoft could, maybe they would. Either way, they appear to have exclusivity over the use of these products. It's been reported that the entire volume of data and compute is going to Azure, and that Bing would have exclusivity on using ChatGPT for search. If that's the case, just making an investment should be good enough.
There is now a counterplay as well to any type of artificial intelligence kind of either written product that is online, or just the general framework of how artificial intelligence can be kind of incorporated within writing papers, people who are or students who have used ChatGPT to be able to do this. And now the counter to that is the detection mechanisms to understand what is artificially intelligence generated versus what is not. How much is that a major headwind for the success of ChatGPT in the future as well?
There is going to be some cat and mouse game, especially in the field of education, where teachers and professors are going to try to figure out if the student actually wrote the paper. But realistically speaking, the next generation of this technology, GPT 4.0, that's going to come out later this year, is going to be educated with 10 to 100 times more data than the generation we're now using, which is to say, when you say, write me an essay on this topic, that's one thing. But when you can start saying, write me an essay on this topic as if I'm an 8th grader and make some mistakes so the teacher doesn't catch me, and ChatGPT does that,
oh, no.
It's going to be very hard for teachers to get.
Okay, so that kind of raises the question of whether there is an ethical responsibility that needs to be layered into how this operates, how this artificial intelligence is able to be incorporated, regardless of how good it can be in kind of streamlining search results or simplifying some tasks that are otherwise, just onerous. Where is that extra layer of ethics within how this artificial intelligence operates?
That's a great question. That's the most important question right now. In fact, I believe when using ChatGPT that it's being throttled and governed by OpenAI to not do anything and say anything. And one of the reasons Google is holding back on Lambda is specifically that once you unleash this and give it all the capabilities, it might do things that we are uncomfortable with and that we really have to figure out the ethics around. And we need to do it now because these capabilities are very, very significant. And so that responsibility right now falls to Google and it falls to OpenAI. And we better hope that they're trying to be ethical about it because the capabilities are very significant.
Well, big tech has a long history of being ethical, Gil, so I'm sure we're in good hands. We'll talk more about that the next time. Gil Luria, D.A. Davidson Managing Director, thank you so much. Really interesting perspective on a fascinating ongoing story. Appreciate it.
Thank you.
Straight ahead, we're going to check in with our crypto reporter, David Hollerith, on the latest happenings in that space, including a drop in investment. That's next.
Sam Bankman-Fried, who last week pled not guilty to 8 criminal counts, may face some more troubles ahead as FTX's former engineering chief reportedly met with federal prosecutors for chance at receiving a plea agreement. That's according to Bloomberg. Here with the details is Yahoo Finance crypto reporter David Hollerith. David.
Brian, Nishad Singh hasn't been charged by the Justice Department for any wrongdoing up to this point. He did meet with federal prosecutors per Bloomberg, as you mentioned. We also know that Singh lived with Bankman-Fried and Alameda Research CEO Caroline Ellison and FTX's CTO Gary Wang in a Bahamas apartment. Singh is sort of the fourth member of so far of what's been identified as Bankman-Fried's inner circle. A former Facebook engineer and later employee for a short stint at Alameda Research, he went on to be part of FTX's founding team alongside Bankman-Fried and Wang, and served as the exchange's head of engineering, as mentioned. Wang and Ellison obviously have pleaded guilty in December, shortly after Bankman-Fried was extradited to the U.S. And whether or not Singh takes a plea deal obviously will depend on the value of his testimony. A preliminary sketch of FTX in bankruptcy court documents shows that he held a larger controlling stake in FTX's U.S. subsidiary, which appears to be slightly more shielded from some of the problems with customers having to get back their funds. He also had some ownership in the venture arm of the company. We also know from the same court document that he took a $543 million loan from Alameda Research. And before FTX's collapse, he was a significant political donor. His donations, always to the Democratic Party in federal election campaigns, especially in 2022, amounted to $8 million and often mirrored Bankman-Fried's donations. That's all we have at this time, but we're likely to look for things that potential other pleas that we have seen haven't covered, which would be something along the lines of charity and political donations, which are the later counts of fraud that Bankman-Fried is accused of.
And sort of unrelated, but not necessarily directly related, elsewhere in crypto where we're seeing some fallout of vulnerabilities in the system, let's call them, Cameron Winklevoss wrote an open letter to Digital Currency Group today. What did he say, and what's the latest in the sort of back and forth between them?
Yeah, I suppose it is all related. Crypto, these major players all had lending and borrowing relationships. In this situation with Gemini and DCG is sort of circling around Genesis, which was a crypto prime broker that has since paused its lending business and still has a trading operation that's still operational seemingly, but the company is kind of circling around and potentially considering bankruptcy. And since Genesis had about $900 million of funds that belonged to Gemini's earn customers, Gemini has been pursuing this situation. They've actually formed a creditor committee and are sort of taking this as a bankruptcy approach, even though bankruptcy has not happened yet. Now, Gemini CEO Cameron Winklevoss has been pretty vocal about this, coming in, trying to give updates about the situation. And DCG so far hasn't publicly, at least, been playing ball. And it seems like, the private conversations are not really moving along as much as Winklevoss wants them to. So he is actually accused, as of this morning in this open letter that he's published on Twitter, he's accused DCG allegedly of misleading customers in their statements. This is related to this promissory note, which I'm sure we'll hear more about, which was related to DCG taking the losses of Genesis's that was suffered when Three Arrows, a heavy borrower from Genesis, defaulted over the summer. DCG took a $1.1 billion promissory note and gave to Genesis. And that effectively looked like DCG bailing out its portfolio company, Genesis. And Winklevoss now is alleging or accusing that DCG, which he's holding responsible for Genesis's situation, as sort of misleading customers and clients as to whether or not Genesis was financially solvent after this note was shared back and forth between DCG and Genesis. So obviously, it does sound a little complicated, but I think the question obviously is what's going to happen in bankruptcy, and I think that's where more of this will be decided. Gemini, obviously, with this kind of language, could be pushing the company, Genesis, to filing bankruptcy more quickly. They are one of the largest creditors in a potential bankruptcy for the company.
Oof, lots more to come, Dave. Thanks so much, our David Hollerith. Coming up, we're going to continue talking about the implications of what's been going on in crypto. Coinbase is slashing a fifth of its workforce to combat the crypto downturn. The stock's been bouncing around today. We're going to speak with Mizuho's Dan Dolev. That's next. Shares of Coinbase trading a little higher following news that the company is set to lay off 20% of its workforce. That affects about 950 people as it grapples with a downturn in the crypto market since the collapse of FTX. Mizuho Managing Director and Senior FinTech Analyst Dan Dolev is joining us now. Dan, you downgraded the stock to an underperform about a month ago. You had been neutral on it for long before that. When do we get a table reset for Coinbase? What would it take?
Miracle.
And I guess cutting 20% of the workforce is not a miracle.
No, and I don't think it's enough. I actually think so. We did some math around it. So they're going to be saving about $250 million per quarter. That's $1 billion per year. This is not the problem, right? So we've been the street bear on this one for a while. The problem with Coinbase is that their business is troubled. Their business model is defunct, right? So they make money off of retail trading. And because of the crypto ice age, retail trading is basically non-existent. So at the current volumes that they're running, about 1.2 billion a day, there's no way they can cover their costs. So I expect actually more pain in 2023. I don't understand why the stock is up today. I really don't.
Dan, in the non-trading related revenue streams that I believe we talked about at the tail end of last year with you, where do you believe that they'll actually be able to kind of drive some of that demand generation in order to ensure that within each of the cost-cutting measures that they're implementing, that on the other side of that, there's an equally balanced kind of run rate that they can kind of march towards that investors can hang their hat on?
Sure. Yeah, and you're talking about the SaaS, the so-called SaaS revenue, right? The software and services revenue. So, this is a huge uphill battle. I think we're modeling, roughly, just under $1 billion for next year. The run rate right now is about 700 million. I mean, I think that the fallacy of this thing is that people are looking at it in a silo. It's highly correlated with crypto retail trading volumes, which means that if our prediction that crypto retail trading is basically going away and the fees are going away, I think you'll see those those SaaS revenue related stuff going with it. So it's reinventing the crypto economy, which is like pushing a 747 jumbo jet up the hill. I mean, it's a very hard earned revenue, and I don't see much. I'm not very optimistic about that revenue stream at all.
Dan, the last time we talked to you, we were talking a little bit about Robinhood, I believe. Do these cuts from Coinbase, what does that mean for Robinhood? Do they have to cut further?
Robinhood is actually in a great position. I mean, I met with Vlad, and I think we talked about it last time. I met with Vlad in November in Palo Alto, and they're basically beyond the big cuts. They're now, basically making much more, or losing less money, so to say. And the good thing about Robinhood is, remember, like, crypto is only one facet of this whole, revenue stream. And the trends are actually looking good. If you look at the November trends, December trends, they're actually looking good. So they're on a good trajectory, and they're coming up with a bunch of new products that are non-crypto related, like the retirement, et cetera. I'm very, very optimistic about Robinhood. I could not be more bullish about Robinhood and could not be more bearish about Coinbase at this juncture.
With regard to the vacuum of just confidence around crypto projects more largely, and when that could actually come back in enough force for these companies, for Robinhood, for Coinbase, even for a Square and a Block and a PayPal, to also see some type of rising tide. I mean, how long would you predict that this crypto winter continues to last and really have that impact on sentiment from new and even existing holders or hodlers?
I personally don't think that we're going to get to see, I guess on Wall Street, the new thing is a year as a career. I hope it's a little longer, but I don't think that in our, I wouldn't say in our lifetimes, but I don't think in the foreseeable future we're going to see that super bubble, that COVID-infused super bubble that we saw with crypto, where everyone was trading. I don't think we're going to see that. I think it's all sort of backward looking. Those are the relics of an era that's not coming back. I think it's kind of over for Coinbase. I mean, sad to say that, but I think it is. By the way, Block or Square, that over focus on Bitcoin, I think is a big mistake. And also the change in the name, but that's a different topic.
Dan, when you say it's over for Coinbase, so are they not around in a couple of years? Does somebody come in? Are they part of another larger company?
I mean, I think it's over from if you think about I'm thinking for the business model, I think it's over for them, right? Because remember, I can't predict whether or not they'll be around or not and how much cost cutting they can do, but think about how they make their money. They make their money on charging very high retail trading fees. And if I think about where that is, the trajectory of where this is going, it's getting worse and worse every day. And I don't see that changing. I don't see the Dogecoin kind of, hyper bubble coming back anytime soon. So could they be part of a bigger, different company? Potentially, but I can't predict it. But I think their business model is very, very challenged. And I think it's getting worse, not better.
Mizuho Managing Director and Senior FinTech Analyst Dan Dolov, always good to see you. Appreciate your analysis.
Anytime.
All right, House Speaker Kevin McCarthy passing his first leadership hurdle with the approval of a rules package dictating how the House would run. This, of course, comes after a historic 15 rounds of votes to win the election for Speaker. Joining us with more on how the new rules are set to affect Congress is Kevin Cirilli, Yahoo Finance contributor. Kevin.
Well, the biggest takeaway from Speaker McCarthy's gamble over the rules package is that it has diminished his leverage in negotiating with the Senate during the debt ceiling negotiations expected to occur in the end of this summer or early fall. Now, why does that matter? moderates in the House of Representatives are now increasingly frustrated, and you saw this a little bit going into the Sunday shows, that they do not have as much leverage, and that Speaker McCarthy conceded that leverage to the ultra-conservatives in his caucus. That, from a business standpoint, when you look at the debt ceiling fight that's just around the corner, could increase the chances of volatility coming out of Washington, D.C., specifically as it relates to a likelihood increase that there be a stalemate over the debt ceiling. So some fascinating foundations and markers that are being laid this week in the dynamics of the new Republican caucus.
Well, and what's interesting to me about this as well, Kevin, is that while this was going on, while the votes after votes after votes were happening, there was this perception that the Republicans were in disarray and the Democrats could somehow capitalize on that. Now with this, that doesn't seem to be, I mean, that moment has passed, no?
Julie, that's a great point, because the Democrats, in choosing to continue the dysfunction from the Republican caucus, have actually ceded leverage to the ultra-conservatives, in the sense that typically in the previous couple of Congresses, at least, you'd have to go back even further, the House of Representatives would be able to negotiate with the Senate. But what Speaker McCarthy just showed is that because he's giving such a loud voice to the far right in his caucus, he's emboldening them, and they are trying, keyword trying, to diminish the clout in the upper chamber. And that's going to be really, that's the battle line. It's really now the ultra-right in the House versus the Senate.
Kevin, while we have you, the Biden administration also kind of unveiling some plans regarding student loan holders. What do we know about this?
Yeah, this is expected to be finalized by the Department of Education, which has come out and said that for qualifying, keyword qualifying student loan holders, that they might be able to save something like $2,000 annually. It could also significantly reduce the rate at which borrowers are paying back their student loans by as much as half. So the Department of Education continuing that. Now, remember, we've been in this period of student loan forgiveness. The administration has forgiven for thousands of Americans who have borrowed student loans. So this is, again, part of that process. Republicans are going to push back on this, but as we've also seen from the midterm elections, has been a tricky political argument for them to make. But this broader idea of who gets student loan forgiveness and what relief folks who are not, who have not received a college education get is ignited in the culture wars as a result of this.
Kevin, we're going for the double bonus here. The Justice Department also looking into some documents that were found at the Biden, at his former office, at President Biden's former office. What's the details there, and what's being looked into and investigated? So
let's quickly go through three things. One, the Department of Justice being made aware of these documents at then at the time, the former Vice President Joe Biden's think tank. Shortly before the midterm election, they were made aware of these documents. Now, secondly, today, the Department of Justice, Merrick Garland, has said that he is going to look into those documents, but he said that today. So third and finally, conservatives, Republicans are arguing, well, hey, wait a minute. If Garland knew about this before the midterm elections, why is it just being made clear now? And Republicans up on Capitol Hill are forcefully asking that question. And so, this is definitely, the Republicans have said that they're going to be looking into the Biden administration. We'll add this to the list of things that they are going to be looking into, specifically about why the Department of Justice waited until now to say that these documents existed, as well as the contents of those documents.
Yahoo Finance contributor Kevin Cirilli. Kevin, thanks so much for breaking that all down. Appreciate it. And
Thank you for having me.
Absolutely. Coming up, everyone, a blowout championship as Georgia wins back-to-back titles. We'll discuss this next. Welcome back, everyone. Time for Cup Time. 3 stories, 1 minute each. Let's start with this on the day. KeyBank is bullish on dating, upgrading Bumble to overweight from sector weight, citing increased confidence in the company's growth and a stable competitive backdrop as pressures from the economy moderate. And it really is about how much users are going to continue spending into the platform that either allows them to find love or find a best friend or find a business partner, and how much they kind of pay more into that experience as well.
Yeah, this was such a 2022 call, I would say. We saw a lot of these calls from the banks. When the economy opens, people will be out there dating. I get it, but I think Bumble has seen some operational challenges in recent quarters. And secondarily, if there is a recession, that thesis that love is resistant to recession maybe puts to the test. It is expensive to go out there on dates. It is expensive to go out there and eat right now, hundreds of dollars on a weekend. I mean, maybe people don't have that money.
I'm going to not ask any follow-up questions to Brian Sozzi about his thesis on this one.
I notice my face hasn't changed.
I'm going to resist that strong impulse that I have and just say it's interesting to see this call and that Bumble shares are going up today. Yeah. All right, Shake Shack, those shares, we're watching them today after the company provided preliminary results for its fourth quarter and fiscal year ending December 28th, announcing revenue of $238.5 million and system-wide sales of $364 million for the fourth quarter. The shares are down about 1%. The company's still planning on opening, 15 to 20 Shacks this year, I believe, so still expanding.
Even a date night out for a Shake Shack is expensive, Julia. You're looking at $40, $50. Yeah. You order 2 hot dogs, 2 hamburgers, some cheese fries. I mean, maybe a diet soda. I mean, wow, that's pretty expensive. Yeah. Pretty expensive.
They opened 36 new domestic company-operated Shacks in fiscal year of 2022, and then 33 new licensed Shacks during the year as well. 13 of those in the fourth quarter. And so it also comes with system-wide sales that were actually same Shack sales that were up by about 5%. But yeah, I used to go to Shake Shack a lot.
What? I was just thinking, like, don't you feel like the novelty is sort of off, right? Like when a Shake Shack opened, it was like, wow, this is cool.
Like finally.
And then I
get more excited for a Chick-fil-A opening now.
Oh wow. Yeah. I did not expect that pivot. Yeah. No, Saz is
not. No way. Shake Shack's awesome. All right. From sports to from food to sports, Georgia defeated TCU in a blowout score of 65-7 last night, becoming the first college football program to win back-to-back championships in the 9-year playoff era. This caps off an undefeated season for the Bulldogs. I did not see this game, but it ultimately gets me very excited about NFL's playoff season, which is ready to rock and roll.
What else it should get you excited about is one of the tickers that's on the Yahoo Finance platform, Nike, NKE. Huge exposure, and you can think across the kind of bowl playoff era that we've seen for college football, even into March Madness, and the amount of exposure that each brand is getting because of some of the school partnerships that they have. Nike shares up by about 0.5% here on the day. Of course, Adidas, Under Armour have been buying into more of those partnerships as well, trying to equip the different universities that have the best chance at getting into those late season playoff performances and whatnot. But again, Nike kind of performed well here on the day. Under Armour actually up by about 1.5%.
I mean, I know Georgia was favored, but I gotta wonder what the odds makers, like what that happened when you have that.
This was a terrible game.
Yeah,
it was terrible to watch.
All right, coming up, Rochelle Akuva will continue our Coinbase coverage with Jefferies analyst Trevor Williams. Stay tuned.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm looking at today. Unfazed. Can markets keep the upward momentum going despite hawkish Fedspeak? This as Chair Jay Powell addresses the world's oldest central bank. He says fixing inflation can mean making unpopular decisions. And pushing back, China retaliates against South Korea and Japan for COVID restrictions on Chinese travelers by blocking short-term visas. On the market side, Morgan Stanley follows Goldman Sachs by getting bullish on China's assets. And more cuts. We'll talk layoffs as Coinbase slashes around 20% of its workforce. Meanwhile, in the tech sphere, Amazon looks to close warehouses in the UK. This after upping overall layoffs to 18,000 last week. But first, let's take a look at how the major indices are faring. Quite a bit of oscillation, but still relatively flat, but in positive territory. We see there the Dow up about 70 points, the S&P 500 up about 5 points. The tech-heavy Nasdaq there up just about 0.2% on the day. Let's also see what we're seeing with the Treasury market that we tend to see respond anytime we hear from Fed Chair Powell. We see the short-term 5-year there up about 2% on the day, the 10-year up 2.79%, and the longer-term 30-year yield up 2.6% on the day. Well, Fed Chair Jay Powell out this morning with remarks out of Sweden, Riksbank, pointing to the Fed potentially taking unpopular measures in the fight against inflation. Here with the details is Yahoo Finance's Jennifer Schonberger. Of course, everyone always hanging on Chair Powell's words here.
Good morning. That they are. Fed Chair Powell making the case for Federal Reserve's independence at an event in Stockholm, Sweden this morning. In a speech and subsequent Q&A, Fed Chair Powell appeared to defend the central bank's aggressive interest rate hiking campaign while framing the Fed's independence as necessary as the Fed looks to tackle bringing down high inflation. Take a listen.
The case for monetary policy independence lies in the benefits of insulating monetary policy decisions from short-term political considerations. Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy.
Powell's comments come as the Fed has raised rates by 4.25 percentage points over the past year in the most aggressive campaign since the 1980s. Fed Chair Powell has repeatedly warned that while bringing down inflation will be painful, not doing anything and letting inflation fester would be even more painful. Now, in that speech this morning, Powell said the Fed should resist the temptation to broaden the central bank's scope to include social issues, including climate change. He says without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy. We are not and will not be a climate policymaker. Though when it comes to climate change, Powell noted that in his view, the Fed has narrow responsibilities to oversee climate risks as it relates to the financial sector. Back to you.
All right, thank you for that update. Jen Schonberger there for us. All right, well, let's continue to digest the Fed speak and the market reaction, or lack thereof, with Alex Morris, FM Investments CIO. So, Alex, as we're looking at the market reaction today, it's still relatively flat. It appears that the markets are already priced in what they think Powell is going to say at this point. What's your take on how the markets are reacting?
I think the markets are finally reacting appropriately to Chair Powell's responses. For a long time, whenever the chairman would speak, markets would misinterpret rally, and then he would go on a relatively abrupt campaign to bring them back down. But now they've appropriately priced in the messaging, and the messaging has been much more consistent, not just from Chair Powell, but across all of the governors, which I think has brought some calm to the equity markets and some normal behavior to the responses and to the comments that he's made.
And we know that other overhangs include what we're going to see in terms of a recession. And as we look at the further deepening between the 2 and the 10-year bond yield, obviously one of the signals that indicates a recession could be here. But then you also have a strong labor market. As you look at some of the nuances in this, how do you position yourself in this sort of environment?
Well, we think investors are going to do well in the credit space and certainly in the U.S. Treasury space. Probably more on the short end of the curve than on the mid end or certainly on the long end.
Most of the smart investments we see today seem to be in the 3 years and under space. As you noted, where the 5 years trading today and the 2 year trading above that as well provides a very attractive return. We see short-term corporate debt probably in the 5.25 to 5.5 space over the course of the year, and a substantial number of issuances in the corporate credit space, issued all under a year, all with very attractive coupons. I think that's probably a good place for investors to be. We've made that easy to invest in the treasury space through some of our single treasury ETFs. And we see a lot of activity on the 2 year and the 90-day products and our 1 year product as well. And think that folks in T-bill, O-bill, and U2 are probably in the right space. And we'll continue to see flows there because it provides a good yield and an attractive, safe investment in the treasury, underlying treasury.
And what kind of timeline are we looking at? Because you've said in your notes that 2023 will be the year of the bond. Why so laser focused on that?
Well, if we look at what happened in the equity markets in 2022, things didn't go as planned. And certainly a good chunk of what had happened over the prior decade and beyond that was as a result of interest rates coming down. There was no more down to be had last year, and a new rate cycle started. We think when that happens, there'll be a return to credit as folks now can get an actual attractive return from credit, which they couldn't get in the prior 5 or 10 or longer period of time. And I think that is going to refocus institutional allocators away from equities in general and in towards a good and diligent credit underwriting effort that was much more common even 10 years ago, 15 years ago. The question is, are there enough folks on the desk who remember what those experiences were like, who can actually go in and do that good credit work and then be rewarded for those energies?
And I want to take a look at what we're seeing with some of these S&P predictions. You're expecting about 4,100. The more bearish Michael Wilson from Morgan Stanley predicting the S&P could fall to as low as 3,000 points. What is the bullish case as to what will drive that?
Well, I'm hopeful that 3,000 isn't the case, as that would be 800 points south of where we are today. I think the consensus tends to be around that 4,100, and I took the easy road out and agreeing broadly with consensus. Markets are down substantially, but there's still demand for equities. There's still a lot of investment dollars to go into the equity space. As we look at rates coming to a terminal level, Jamie Dimon this morning put a coin flip of 5% and a coin flip at 6%. If we sort of split the difference and say they end in the mid 5s to high 5s, that does mean at some point the Fed will need to take a pivot or at least a pause that will give the equity markets an opportunity to go and perhaps to take off a little bit. But I think broadly speaking, there's still a lot of great companies out there. And the easiest way to access those companies is through the equity markets. And there's still great growth to be had in those companies, even if a technical recession does occur. As you noted, it'll be one with very strong job demand and still high wages and highly productive companies. And although the prior recessions were ultimately turned around by industrials, this one will have to be turned around by technology. I don't forecast many people stopping asking for iPhones and subscription services for Christmas and going back to asking for horse and buggies or for large steel and iron projects.
Certainly. I mean, we know that they are going to be cutting back, though, as we already have seen some of that demand waning. I did want to get your take on earnings season. You mentioned Jamie Dimon, the big banks kicking off this Friday with earnings season. What are your expectations there?
We think banks' earnings will be good to strong. Interest rates rising does give banks the opportunity to make a heftier margin. And we think the banks have been well positioned. They learned their lessons from 2008 and have been more financially better managed along the way. I think they're very much afraid of recession. And as some of them have come out and started to cut aggressively, or to cut jobs aggressively, which I think is the right move for them to make. That said, we do note that the banks are, generally speaking, bigger in both assets and in terms of FTE than they were a decade ago. But given the lessons they've learned and just the underwriting standards they've put in and regulation, that some of which has been beneficial to preparing them for these sorts of events, they're very well capitalized and will do well to, even if there is a short term or a shallow recession, they're well positioned to continue to earn hefty profits and to grow those into the coming years. So we're looking forward to a positive earnings season for banks.
We'll certainly be keeping an eye on some of those earnings calls. A big thank you there to Alex Morris, FM Investments CIO. Have a good morning. Right, shifting the focus now to China as Beijing issues its first COVID retaliation after a number of nations implemented restrictions on its travelers. This, of course, following the dismantling of China's COVID zero policy. We're here to break it all down is Yahoo Finance's Inez Ferre. Inez, what are you watching at the moment?
Yeah, Rochelle, well, we are watching Chinese ADRs. As you just mentioned, China putting some restrictions on the visas, short-term visas from Japan and also South Korea. This is in retaliation to Chinese travelers and the curbing that some countries have done with perhaps reducing some flights and also requiring COVID-19 tests from Chinese travelers. So a bit of a retaliation there. But just looking at the Chinese ADRs today, we are seeing a bit of a mixed picture. You've got Alibaba that's up more than 3%. NetEase is also higher. I do want to point out that over the last couple of months, we have really seen these Chinese stocks soar. I'm pulling up a 2-month chart here. You can see that Baba is up 64%. So much of this is on the expectation of that full reopening of China. Easing of regulations also when it comes to these Chinese big tech firms and authorities in China putting economic growth above all else. Also, there's been talk about Chinese regulators helping to shore up the balance sheet of Chinese developers as there is a property downturn happening in China. So you have seen these Chinese ADRs really pop. And in fact, because of the reopening as well, this has prompted some bullish calls. So I've been watching the Morgan Stanley put out a note about Chinese assets, expecting Chinese stocks to outperform other global stocks, and also expecting the Chinese economy this year to increase by 5.7%, grow by 5.7%. And that's versus a consensus of an increase of 4.8%. So Morgan Stanley very bullish on China. Goldman Sachs also recently had a bullish note on China and the reopening of China. Rochelle?
Certainly be keeping along on that long and probably truncated reopening for China. Thanks for that update, Inez Ferre, there for us. All right, we're taking a look at shares of Bed Bath & Beyond soaring following its long-awaited holiday quarter results this morning. The retailer missed analyst estimates as net sales fell 33% year over year, driven by a slowdown in customer traffic and constrained inventory. Now, this comes 1 week after the company indicated it was considering filing for bankruptcy as it explores strategic alternatives. All right, coming up, who's in the driving seat? A federal agency doesn't like the look of a tweet from Elon Musk on driver monitoring. This as it says a larger investigation into its autopilot function is moving fast. The full update next. Now to the global demand story. Auto sales in China rose 2.4% in December as consumers look to make use of ending subsidies for electric vehicles. Well, for more on what's next for the world's largest car market, let's get to Yahoo Finance's Pras Subramanian. So what's going on here, Pras?
So you saw that slight uptick in December as buyers sort of pushed forward some of their purchases because they wanted to take advantage of those ending government subsidies, right? So we saw that happen there. But also analysts are expecting some pain to come in January because we saw those incentives end. Plus also you have the January holiday, the New Year's holiday in China, which is going to shut down the economy for about 10 days or so. So we'll see some pain there. Analysts at JP Morgan saying it's going to be called a transitional pain period that end of the month, January and February region because of the fact that of those sort of slowdown in purchases. So the result has sort of led to a lot of price cuts in automakers. There, you saw Tesla last week doing this as their sales fell 41% in December compared to a year ago. A very kind of stunning sort of collapse there in terms of sales because of the fact that there's been a lot of competition in that space. Nevertheless, the CPCA, which is the Chinese Passenger Car Association, they see new energy sales, that's hybrids and EVs, sales hitting 8.5 million this year. That'll be 36% of overall sales for the market.
We'll be keeping an eye on that as China continues to reopen, perhaps see some of that demand bouncing back. Pras Subramanian, thanks so much. All right, well, now to a growing battleground. Apple's push to produce more of its own chips weighing on key supplier Broadcom. The iPhone maker looking to replace their chips with its own in-house design as soon as the end of next year or early 2025. That's according to reports from Bloomberg. Well, for more on the chip crunch, let's get to Yahoo Finance's Dan Howley, this ever-going push and pull for these chip makers and these device producers.
That's right, Rochelle. These new chips or Apple in-house chips would replace those from Broadcom as well as Qualcomm. We originally talked about Qualcomm's chips being replaced potentially this year, but Apple seemingly didn't have them ready enough. So Qualcomm will continue to put its chips in the iPhone at least for 2023. But as you were saying, potentially 2024, 2025, we could see Qualcomm and Broadcom out of the picture, at least partially. This is the bigger hit for Broadcom because Apple is its biggest client. It's really the kind of Bluetooth chip that would be inside of the iPhone. And, you know, this is something that Apple has kind of continued to do where they try to bring their chips in-house rather than relying on partners. The reason for that is obviously higher margins for Apple. They don't have to provide any kind of payments to these partners, no long-term deals. They can do it on their own and in their minds seemingly do it better. When they did away with Intel for the Mac and MacBook line, they improved battery life for the MacBook line dramatically. So their thinking is clearly, look, if we can do that with a CPU, we can do this with these accessory chips and potentially improve the overall performance, but more importantly, save, because we'll be the ones producing these chips or at least designing them. And so we don't have to go out of our way and then pay the likes of Qualcomm or Broadcom. Now, on the Qualcomm side of things, as I said, this is something that's been telegraphed for quite some time. This doesn't come as a surprise, really. But for Broadcom, it does seem a little more of a surprise, at least to the markets and for people that watch Broadcom. So, you know, this is going to be kind of a really shaky situation for them as Apple weans themselves off.
Apple always sort of tightening that ecosystem. It's a smart move, though. A big thank you there to Dan Howley. Thanks so much. All right, coming up, more pain. Jobs cuts continue to plague the crypto sphere. Coinbase now slashing a fifth of its workforce following an 18% reduction in June. Jefferies just initiated coverage of the group. We'll check in with them next. Let's take a quick look at Bitcoin's price action this morning. We see it's in mildly positive territory, but traders are staying out of Bitcoin despite a more risk-on attitude from broader markets. This according to CoinDesk, with waters deemed too shallow to support moves from so-called crypto whales. Bitcoin, the world's largest digital asset by market cap, remains the most liquid cryptocurrency and is preferred by large traders over other coins. Now, the overall crypto market, of course, still reeling from the fallout from FTX's collapse, along with its affiliate Alameda Research, no longer providing much of the liquidity that the market relied upon. Well, turning to another headline in the crypto space, Coinbase cuts back. The crypto exchange set to lay off 20% of its workforce in an attempt to weather the market downturn. Now, the cuts are set to affect about 950 employees. And our next guest is still sticking with its hold call on Coinbase. Joining us now, Trevor Williams, Jefferies Payments and FinTech Senior Analyst. So, as we've seen here, we've got these job cuts here, but you have a hold rating here and a price target of about $35 here. What is the optimism? What's driving this, as we've seen some downgrades lately for Coinbase as well?
Well, I think we tried to couch our call of yesterday in our initiation is kind of a near-term versus a longer-term potential story. In the near term, we're not saying anything new. I mean, this is a very difficult operating environment for Coinbase. Retail trading was already under significant pressure prior to the collapse of FTX. In the time since the collapse of FTX, average daily trading volumes are down about 40% from where they were in early November. And so, I mean, this is clearly a reactionary move to a worsening operating environment. And I think that there's a kind of a tacit admission that it's going to be a lower for longer type retail trading environment, which is kind of the key model driver for Coinbase. And so, I mean, we view the cuts as necessary. We were expecting an additional round of cuts to come sometime in 2023. So we're a bit surprised by the timing, but not at all the fact that they're going to need to react to what is clearly just going to be a softer trading environment for a prolonged period of time.
And in an interview, Coinbase CEO Brian Armstrong cited the unscrupulous actors, referring to, of course, Sam Bankman-Fried and FTX, and talking about the contagion here. Even though Coinbase wasn't obviously directly involved with what's happening with FTX, some of the trust that was lost here, obviously it's making retail investors particularly start to continue to withdraw from this point. How long does this contagion continue? When does this final shakeout settle in?
Well, I mean, the challenging part about investing in the space is that we don't know. And that's why we said investing in the crypto ecosystem writ large is very difficult to do in the near term. I mean, we do think companies like Coinbase, who are onshore, regulated, publicly traded, audited companies who have been at least more proactive in terms of regulatory compliance, we think Coinbase kind of has the chance to be a net share gainer if and when we do get back into another up market. We're not making the call that's going to be the case, but we're just saying that in an ecosystem that is kind of increasingly fraught with risk and a lack of consumer trust, I mean, Coinbase has a premium brand. They have a track record of compliance, of not gating client withdrawals. So they really are the good actor in the ecosystem. So they do stand to be a net beneficiary longer term if we do go back into another up market, which, I mean, that is too difficult of a call for us to try to make. And so that's why we stuck with a hold rating when we picked up coverage.
And as you sort of draw some comparisons with other exchanges, I know that you like also the strong balance sheet that Coinbase has. What do you think is going to be the difference maker for Coinbase versus some of these other exchanges that might be in trouble?
Yeah, I mean, I think you called out the most important piece, which is they've got $5 billion in cash, $3 billion in net cash. Clearly, post the OPEX reductions that we'll see come through, really starting in 1Q23 from the headcount cut. I mean, they're going to be moderating their cash burn, hopefully throughout 23. I mean, I wouldn't be surprised to see another round of OPEX reductions at some point next year if trading stays kind of at the 4Q run rate level. So, I mean, we do think they have the liquidity to weather a prolonged downturn. They are, I think, better positioned than others to be able to withstand what's going to become increased regulatory scrutiny. We'll see what sort of legislative action comes out of Congress in response to the FTX fallout. All of that makes for a continued challenging environment in the near term, but we think they are going to be better positioned to weather a longer downturn. I mean, we're not making a call that, things get all that much better in the intermediate term. We just think they have the liquidity, they at least have the infrastructure built internally from a compliance risk tax standpoint to be able to deal with increased regulatory scrutiny. And so, I mean, we do think that they are a long-term net share gainer as a result of all of that.
And do you think, given that we've seen the amount of retail trading volume declining as we've seen some of this trust sort of wither away, can you really have a good solid rebound for Coinbase if you also don't have sort of a rebound in what we're seeing in crypto tokens as well?
No, I mean, so goes retail trading, so goes Coinbase. And retail trading tends to contract more in down markets and do better in up markets. And we see that reflected in Coinbase's total market share, how they've lost share over the last 2 years as crypto prices have fallen. And so you really do need to see another up market. And when I say up market, I mean, you need to see crypto prices higher. We use Bitcoin as kind of the proxy for overall crypto prices, but you do need to see crypto prices recover for this stock to work. And we have no visibility into being able to make that call. And so that's why, again, we stayed with the rating that we did.
And I want to ask you about Binance. A lot of people wondering what's happening there. They've also seen sort of record withdrawals coming over the last 60 days, about $12 billion being withdrawn there. How much more contagion do you think will Binance and any issues there further affect other exchanges like Coinbase?
Well, look, I mean, we just go back to the fact that Coinbase, from a risk management standpoint, has been very well insulated from the collapse of FTX, from earlier issues this year tied to Voyager, Three Arrows, and Celsius. There was no ripple effects on the Coinbase business aside from just overall market activity. So we've seen their risk management capabilities kind of proven through down cycles already and through other, I'd say, kind of exogenous events in the ecosystem. So I've got full confidence that if there is more shakeout across the ecosystem, that Coinbase, aside from what it's going to mean for just trading volumes at the industry level, is going to be fairly well insulated.
And then looking forward then, in terms of downside risks that you're keeping an eye on for Coinbase, what are your top risks that you're looking at?
Oh, well, I think it's just that if we stay in kind of a prolonged, subdued environment for retail trading. And I mean, the biggest risk that there is if crypto prices stay where they are or continue to fall. And if crypto prices fall, that's going to hurt their retail trading volume. And that means that the path for them to get back to profitability, to get to free cash flow generation, is going to be that much more challenging for them. And so, I mean, you're really taking crypto price risk by owning the stock here.
Indeed. Well, Trevor Williams there, thank you so much. Jefferies Payments and FinTech Senior Analyst, thank you for joining me this morning. All right, coming up, tough measures. A week after upping job cuts to 18,000 globally, Amazon is restructuring some UK warehouse operations, putting around 1,200 jobs at risk. We'll discuss the latest next. Amazon announced it plans to shut 3 warehouses in the UK, putting over 1,000 jobs at risk. The retail giant said that all workers would be offered new roles elsewhere, but did not specify any further details. Yahoo Finance's Ali Garfinkel is here with the details. So, Ali, more job cuts here.
More job cuts here, Rochelle. This is expected to affect about 1,200 jobs in the UK. And, though we know they'll be given the chance to transfer to other units, but we don't yet know what that means. And my guess is they may not yet either. This is coming at a really difficult time for Amazon. They've just announced that those job cuts that they originally brought up, that were going to be 10,000, could be as much as 18,000, which is almost double. Right. This is for the online retail giant. Honestly, this is a rough time. That last year they were hammered by the consumer slowdown. They were hammered by inflation, and their stock showed, I believe it was over the year, it was about down about 40%. I think they're up slightly today, but not a good day for Amazon, and certainly not a good day for those workers at warehouses in Britain.
And we know that obviously Reddit users, usually very vocal, and they're voicing their opinions on the future of big tech. What do we know about that?
Well done, Rochelle. Yeah, no, this was something I discovered at CES that was quite fun. Essentially, what happened at CES is Reddit went out there and they were like, okay, our users are early adopters. In the early 2010s, they thought EVs and smart homes were going to be big. What else do they think is going to be big? And, they came up with some interesting ideas. For instance, Reddit users do believe we will be socializing in the metaverse by 2025. They also believe that we'll have robot chefs and housekeepers by 2029. They also think space tourism is absolutely happening, and so is lab-grown food. So, I thought it was fun. Reddit kind of threw down the gauntlet. It was like, Redditors know what's going to happen. And I said, okay, let's put it on TV.
I love it. I have my eye on the robot housekeepers and the robot chef. That would be amazing. That I would pay some money for. That's worth it.
I would too, honestly.
Well, always great to get your updates. Ali Garfinkel there for us. Right, well, as the tech industry continues to face uncertainty, industry veteran Yuri Levine has some advice for entrepreneurs in the tech space. Now, Levine is the co-founder of Waze and is out with a new book, Fall in Love with the Problem, Not the Solution, in which he details how he built and sold Waze to Google for over $1 billion and offers guidance on navigating today's tech landscape. He joins us now. Very good to see you here. So a lot of people wondering, when you have a company, how do you determine when is a good time to sell? Because I know Google wasn't the first to offer for Waze, and they initially offered, I believe, $400 million, but you got them to bump it up to $1 billion. How did that happen?
So essentially, and I would say that as a general rule, right? So the reality is that when you make a decision, by definition, this is going to be the right decisions because you don't know what it would be like if you will choose a different path. But in general, I would say for entrepreneurs, if they face the challenge of selling their companies, then I would ask them to ask themselves 3 questions. The first one, is that going to be a life-changing event or not? And if it is, then start to consider that favorably. If it's not, then keep on building your startup until it's become life-changing event. The second one is what's going to happen to your team, to your employees, to those that actually followed you and have built the company for a long while. And if this is going to be a life-changing event for them, then consider that even more favorably. And the last one will be, is that going to be a once-in-a-lifetime startup for you, or you are going to keep on building different startups? And if you're going to keep building different startups, then I would say think favorably. If this is once in a lifetime, then keep it.
I mean, it can be overwhelming, especially in an environment like this. You have high inflation. People are quite comfortable. You have a tight labor market here. What would make people go out and say create something like a Waze when you do already have such big tech competitors in the exact same space?
So at the end of the day, what drives entrepreneurs is a passion for change, is the desire to go and create an impact, change the world, make it a better place. And in many cases, and in particular in my case, this is about falling in love with the problem and not with the solution. And so I would run into different problems and I would tell myself, wait a minute, I can actually change that and I can make the world a better place and impact lives of so many people.
So how do you determine if it's a problem that's worth falling in love with?
So I would say always start with the problem, right? Think of a problem, a big problem, something that it's really worth solving. And then ask yourself, so who has this problem? And if a lot of people have this problem, then go and speak with those people and understand their perception of the problem. And only then start to think about the solution. Now, if a lot of people are going to echo back to you that this is a problem worth solving, then two things are going to happen. Number one, your solution is probably going to be way more focused on what's really need to be solved. And number two, they will help you to fall in love with the problem. These people that will sort of, ask you to solve that for them or send you on a mission to solve that for them will make you fall in love with the problem. Now, when you fall in love with the problem, then you essentially increase your likelihood of being successful for two main reasons, right? One is you have a North Star. The problem is the North Star for your journey, and the journey is going to be long and hard and a roller coaster journey. But if you have a North Star, then the deviations from the real journey is going to be smaller and shorter. And the second one is that the story that you are about to tell is going to be way easier if you focus on the problem, right? If we will be in 2007 and I will tell you I'm going to build an AI crowdsource-based navigation system, then the reality is that you don't really care. But if I will tell you I'm going to help you to avoid traffic jams, then you do care.
So in terms of building a community then, because obviously there were other sort of these map apps before. Google had one, Apple had its own, but you talk about this sense of community. How do you sort of sell that to investors in this space?
So going back into 2007 when we started this journey, Google Maps was just a display map, right? Apple Maps did not exist, right? Bing Maps or MapQuest were basically just a display map. And if you wanted turn-by-turn navigation, then it was navigation devices like Garmin or TomTom and so forth. And the reason that we started that is that we really wanted to help people to avoid traffic jams. And we realized that we will need to have the crowd to create the map data and the traffic information and everything that is being used by the application. And we started with this approach that at the beginning, everyone told me this will never work, right? And these were the nice guys, the lesser nice guys. They told me this is the stupidest idea that I ever heard. But when you try to address a real problem, then you will figure out a way to solve that.
So then as a serial entrepreneur, when you look at the economic environment that we're in right now, what sort of stages should people go through when you're trying to start a business in this environment?
So at the end of the day, the first and the most important phase for all the startups is to figure out product market fit. And for product market fit is about creating value to your customers. If you don't create value, there is no reason for your existence. So essentially, you're either going to figure out product market fit or you will die, as simple as that. In fact, we never heard of a company that did not figure out product market fit. They simply died. But when you think of companies that did, I want you for a second to think about, all the applications that you're using every day, right? So searching Google, using Uber, Waze, whatever it is, right? And ask yourself, what is the difference between the application that I'm using today and the first time that I've used it? And the answer is that there is no difference. We are searching Google today the same way that we search Google for the first time in our life. But it did take Google or Facebook or WhatsApp or Uber or Waze or Netflix a long journey to figure out their product market fit. And once they do, they're on a path of being successful. So from all the parts of the journeys that you will need to go through, from figuring out product market fit and figuring out business model and figuring out growth and figuring out going global and so forth, if you figure out product market fit, you are on a path of being successful.
And Rory, just very quickly, because I want to ask you about the role of AI. We've seen that increasingly being added in as we look at things like ChatGPT. How do you see that really shaping the startup community going forward?
Think of the top 10 companies of the world today, right? So the Google and Amazon and Netflix and Facebook and Tesla and whatever, right? And you look at their journey and you will say, wait a minute, they're very young. right? So the oldest one will be Apple and Microsoft, and they're about 45 years old, right? But if you're looking at Google or Netflix or Amazon, they're about 25 years old, right? And Tesla and Facebook are less than 20. And so at the end of the day, these changes happen faster and faster and faster. And it's very possible that we are in the last month, we have seen ChatGPT as something dramatic. It's very possible that the company will become one of the top 10 companies a decade from now. But it's even more interesting that it's possible that there might be a company that we even haven't heard their name yet that will become one of the top 10. This is how fast things are changing. Now, in reality, ChatGPT, it's not about the technology. What is really important is what exactly we are doing with that. Because in order to become such a dramatic company, you need to change behavior. You need to change the market equilibrium. You need to be in a phase that if you would ask people what it was like before, they don't even remember.
It's very true, and considering how fast OpenAI has grown, it really is remarkable. We will have to leave it there, though. Yuri Levine there, thank you so much. Waze co-founder and author, thank you so much for joining us this morning. All right, stay with us. Coming up, we continue our coverage from the JP Morgan Healthcare Conference with Sergey Saxonov, the first employee at 23andMe. Don't miss it. Biotech has underperformed the broader market for some time. Still, some of the major players in that sector are continuing to create advancements to cure serious diseases like Alzheimer's. One such company, 10x Genomics, recently announced the launch of its Xenium platform. Now, that's intended to help researchers uncover new insights into cell structure and function. Here for more on what that means for health research is 10x Genomics co-founder and CEO Serge Saxonov. Serge, thank you so much for joining us this morning. So for people who aren't familiar with this space, what sort of potential does this have to really shape biotech going forward?
Yes, thank you. Really happy to be here. So our space is, like the way we see it, is really at the fulcrum of innovation. This is, at the very high level, this is the century of biology. Huge advances that are in front of us, like you mentioned, cures, potential cures for Alzheimer's, thinking about cancer, infectious diseases. But underlying all of that is an understanding of the science of the biology. And our space, our industry, our company is committed to building tools and committed to building technologies to advance the understanding of the science, to understand understanding of the fundamentals of biology, because that's what's going to ultimately push forward advances in healthcare and ultimately cures for diseases.
And where do you think we'll see this sort of first coming to pass when it comes to the ecosystem of health?
Well, so it's certainly already happening. There's lots of technology innovation that has been happening for quite some time, and more is coming. And a lot of it is driven by kind of advances in physical technologies, miniaturization. A lot of it is driven by advances in computation, and then just the accumulation of more and more scientific knowledge, biological knowledge. And so there's been a lot of great advances, a lot of great technologies have been built, especially on the DNA sequencing side. But we're sort of on this exponential trajectory where you have to expect more and more that's coming. And so you're able to see the scientists around the world in academia, in biopharmaceutical companies are able to analyze and see a lot more and more of the biology. And that's going to lead to more and more cures. A lot of the diseases up until recently have been very much like a black box. So oftentimes when you're trying to cure, you're really kind of trying to fix a car when you don't know how cars work. And as we're gaining better and better understanding because of new technologies and new tools, now you can drive the progress in healthcare more intentionally. And we certainly still, I would say, relatively early. The amount of biology we don't understand is still much greater than what we do understand. But the progress that's being made is just tremendous. And I think if anything, you're looking at the coming years and coming decades, there's going to be an acceleration of that. And that's really exciting.
And what do you see as any potential headwinds for the company this year?
So the environment, as like the large scale environment, the macro environment has been dynamic. It is going to be dynamic going forward. I would probably point to just the general macro environment as being both potentially challenging. It's just hard to predict. That has been roughly the story of the last 3 years, certainly since the pandemic began. And I think that's what we kind of have to deal with going forward. The fundamentals, though, of both our industry, the potential and the company, all the fundamentals that we have built, our ability to innovate, our scale, all point in a great direction going forward, certainly in the long term. In the short term, there's always going to be fluctuations, and certainly the macro environment is as challenging, as unpredictable as any in recent memory.
Indeed. Still seeing a lot of movement in this space. So congratulations on your latest advances. And thank you for joining us this morning. 10X Genomics CEO Serge Saxonov. Thanks so much. All right, coming up, turbulent times. Are investors intent on putting Southwest's major holiday season meltdown behind them? One isn't so sure, and it's got deep pockets and a history of activism. More on that next. Southwest Airlines is back to business as usual, but its recent meltdown has drawn the attention of investors with a history of shareholder activism, most notably New York State's pension system. Let's get to Yahoo Finance's Brad Smith for more on how the airline plans to address its concerns. Never a good thing when you get the attention of activist investors, Brad.
No, not at all. And certainly a lot of the holiday travel turmoil is what sparked some of not just the investigations that made its way all the way up to the Department of Transportation and the Secretary Pete Buttigieg, who had some stark words for the company, but now the New York State Comptroller. What's important to note here within these comments from the Comptroller is how they're classifying what took place and saying clearly this crisis resulted in profound customer dissatisfaction and is expected to generate significant costs to the company. Some of those costs already communicated by the company. Southwest had already forecasted a pre-tax hit of $725 million to upwards of $825 million to its quarterly earnings after this chaos that had ensued over the holiday travel period, where we know that there was a heavy and outsized volume of travelers that were looking to take to the skies. However, the cancellations, they racked up in magnitudes more for Southwest than other airlines, despite some of the travel situation really stemming from headaches around inclement weather. So really putting this into context and how it's going to impact much of the earnings, and that figure that I mentioned of the $725 million to $825 million, now getting more of the pushback from some of the investors on the institutional side. It's important to note that there's about 75% institutional ownership in Southwest Airlines. So when you do have a big investor, especially at a state level that may control a pension fund, it is increasingly important to keep tabs on how exactly, not just from the state and federal government side, Southwest may be looked into and investigated after this tumultuous event that took place over the holiday travel period, but also from some of its most noted investors here, Rochelle.
Indeed, and certainly leading to some leadership changes in several of the departments, really trying to tighten that feedback loop so they don't end up seeing a repeat of that. Great stuff. Brad Smith, thanks for joining me this morning. All right, well, before we go, let's do a final check of the markets to see how they're faring as we head into the noon hour. We still see that the market's relatively flat today, despite what we heard from Fed Chair Powell. Market's still holding tight at the moment. The Dow there up about 35 points. The S&P 500 they're up 0.1%, or about 4 points. And the tech-heavy Nasdaq there up about 21 points on the day. And in terms of some of our trending tickers that we're also keeping an eye on, still top of the list for today. We've been seeing some issues with Bed Bath & Beyond. That's up 18% on the day. So we'll be tracking that for you as well. Well, that'll do it for now. I'm Rochelle Akufo. Thanks for watching. I'll see you tomorrow at 11 a.m. Eastern.